You're out of luck, maybe out of touch. You only see schmucks and you really had enough. It's not adding up and you just don't understand. A straight shooter, he's a straight shooter. Cut to the chase and he asked if he could be up. A PS, he had a ring on his left hand. Boys are non-committal, always in the middle. It bothers you a little, bothers you a little. Why can't we be like mom and dad? You don't wanna settle, but didn't you get the memo? You only get a date if you're walking in stilettos. This is enough to drive you mad. If you think romance is dead, no. Find an old jukebox full of 45s, pop a nickel in it and it all comes back. If you think romance is dead, no. Find an old jukebox full of 40.
I come here because of the convenience, well organized and great staff.
They have 94 octane at the pump and diesel.
Parkland is a critical component of our organization as they provide the fuel to keep our trucks moving.
We are significant partners with the Sol Aviation team here. They are providing a consistent, reliable and safe fuel supply to all the airlines that service Bermuda. And that of course augurs well for our product, and we are thankful for their support over the months and years of this year.
Air Canada has been purchasing jet fuel from Parkland's Burnaby refinery for many decades. Parkland continues to be a key strategic supplier for Air Canada and is currently our largest supplier on the west coast of Canada.
I'm proud to be a part of a company that's contributing to the renewable energy landscape here in Barbados and across the region.
Over the past 4 years, Sol and Four Seasons formed a collaborative relationship stemming from the deliveries of propane, diesel, and gasoline. Sol team has continued to provide a type of reliability that has helped us provide a premium service to all our valued customers.
You go in, when you go to pay for your gas, they just scan that and that's it. You know, so I mean, if I can figure it out, everybody can.
There's clean gas and good service, and I can get myself something to eat when I'm hungry.
This is a story about Parkland, about our track record and trajectory of customer-focused growth. We understand customers. We've anticipated and met their evolving needs for over 50 years. From a single location in Red Deer, Alberta, to a diverse, integrated company with operations in 25 countries. Encompassing a retail business that powers journeys, provides high-quality food and convenience items. A commercial business that keeps fleets moving, ships sailing, planes flying, islands powered, and homes heated. All supported by unrivaled supply, logistics, and trading capabilities that enable us to safely manufacture, buy, and transport the fuels our customers depend on. Our teams live and breathe customers, enabling over 1 million transactions a day. Our goal is to ensure our customers can make the most of every stop, from powering their journeys through our trusted retail brands, growing and expanding our North American convenience store brand, nurturing our proprietary consumer brands, and expanding our high-quality fresh food offerings. Plus, innovative offerings and technologies that strengthen our connection to our customers. Food delivery to your door. Premium frozen take-home meals expand our food offer. Understanding our customers' journeys to better serve their needs. And enhancing physical customer relationships with digital ones. Our resilient business provides a springboard into accretive energy transition opportunities. From building on our leading renewable fuel manufacturing and carbon offset trading capabilities, to helping our commercial customers decarbonize their activities, and helping our retail customers recharge their electric vehicles. As we look to the future, we see a big opportunity to build on and leverage our capabilities, to better serve our customers, to grow and create value. Parkland has been a leader for over 50 years, and we're leading the way for the next 50.
Good morning and welcome, and thanks for attending our Investor Day. This is going to be a great opportunity for us to talk about our business, some of the successes that we have, the robust business model that we've built, and most importantly, to talk about the future, talk about some of the impacts that we're seeing in the energy transition, some of the opportunities that that's providing Parkland, and the opportunity to continue our journey of growth and creating shareholder value. Quickly, our standard disclaimer. You know, when you do have some time late one night, please do read it. Yep, you heard from our customers, and I want to talk a bit about our team and our purpose. And our team is amazing the way they work as one team to make sure that our customers can talk about us the way they do, to satisfy their needs, to give them the service they're used to. The other thing is I want to acknowledge our frontline workers. You know, we've just been through a pretty tumultuous time with COVID. And you know, our frontline teams, they're used to adversity, right? We operate in cold climates and warm climates. We see adverse weather, and we're always there to make sure that we service our customers. Our customers rely on us to deliver their convenience and energy needs on a day-to-day basis and do that safely and reliably. I'm grateful for that team. I'm grateful for the service that they provide our customers, and I'm grateful for how they continue to grow our business. Get into the day here. I'd like to introduce the executive team of Parkland. So I'd like to start off, talk about 4 leaders that drive our business units. First is Donna Sanker, Donna in the back there. Donna is now coming up to 2 years with us. We convinced her to move from sunny California to Calgary. She came and interviewed during the summer. And she's formerly from BP and was Chief Operating Officer of their retail business in North America. Through her career, she's worked on every step of the downstream value chain and across different functions. So she brings great expertise to us, great leadership, and has really been driving that Canadian business forward. Doug Hawk, our president of the US. So Doug's been with 4 years. He reached a very important milestone recently in that he's grown that business 10 times in 4 years. So this is a business that was, you know, many used to ask, why are you in the US? It's kind of immaterial. Well, it's becoming material, and it's going to become more material. So we'll hear from Doug, and he'll talk about some of the great things he's been doing there. Pierre Magnan, who leads our international business. So Pierre moved, first of all, bought Sol, then got to move with it and run it, and you know, really delighted with the results, given the headwinds in those markets where we've continued to deliver the plan that we set out and promised to our shareholders. And Ryan Krogmeyer. Ryan heads up our supply, trading, and refining business. He's really built the backbone of Parkland in terms of its supply system and our ability to consistently generate value through that system. Moving on, where's Darren? So Darren heads up our strategy and corp dev. I always say he's the invisible hand of Parkland. He's helped us create the strategy that we'll be rolling out today and has certainly facilitated us through that process quite productively. And then also, he's done more deals than most people can ever hope to do in a career and created our business. Ian White, where's Ian? Ian keeps reminding me, hey, I'm the retail guy. And Ian brings a great skill set to us. He heads our marketing business. He's the voice of the customer at Parkland, and also is the custodian and the driver of our portfolio of brands. He comes to us from Canadian Tire originally and has worked in a number of different retail-oriented businesses. Ferio, who you met, intro. Ferio's been with us just a year now, short of a year. Ferio heads up our people, culture, health, and safety. Ferio's passionate about culture, and particularly customer-centric culture, and how to develop a culture that services. And you know, Ferio, in his early days, he spent time in various different industries, but grew up in the airline industry. Grew up at WestJet when they were developing their customer-focused culture that really was very powerful at the time. Christy heads up, she's our general counsel, but is also our chief sustainability officer. has a big role. And you'll have seen it this morning. We launched our second sustainability report, and we've made some really good commitments in there. I'm really proud to see what the team has been achieving there in our commitment to the energy transition and supporting that. And Marcel, where's Marcel? So Marcel's our CFO, again, been with us here a year. You know, it's great. Marcel and I get up early in the mornings, and we go for a run. So at 6 a.m. I met him, and we were running along the waterfront here, and we're talking about the day and all the exciting things we're going to talk about. And he reminded me, look, I've been here a year. When I arrived, I couldn't even meet my team. So he arrived here in the middle of the pandemic. He's done a great job in ramping up, and basically, you know, got an intense focus on systems and process and making sure that our foundation is running well, but also, and you've seen a lot of activity around the balance sheet and making that we shore up our balance sheet to have the capital to fund our plan. So welcome to the team. This team is great. We have the best team in the industry. What I love about it is the diversity that in thought and experience base, and there isn't a challenge that we can't tackle and take to a better place. So getting on to the agenda, you know, I'll lead off with an intro. You'll hear from the rest of the team. We'll try and wrap up by 11:15 and have roughly, at noon, and have roughly half an hour to 45 minutes for questions. So really looking forward to getting into it here. So what are some of the key takeaways from today? So the first thing is we have a proven business model. The business model works exceptionally well, and we've been refining that for a decade now. And I'll talk a bit about some of the improvements we've made there and some of the capability that we now have at Parkland. We have strong fundamentals. There's a bit of chatter right now about what's this energy transition, how's it going to affect you? And we'll talk about some of the fundamentals of our business and how we're well positioned, not only in our base business, but in the opportunities that it's providing. And it really leads me into the third point is we see a lot of opportunity in this energy transition. The change, ultimately, the energy that people consume will still be there. And we'll be there to service those needs as we go forward. And we can leverage our existing asset base quite nicely around that. And what you'll see are some very high growth opportunities that we're already in and already exploiting. And then finally, just as we're leaning into the energy transition, we're also going to lead into our commitments to driving to zero. We'll talk about, you know, government's ambitions to get to net zero and Parkland's commitment to help them get there. So, you know, really an exciting agenda here. Again, you saw the introductory video, which did a good job of explaining our business. But what I would like to say is we are a consolidator. We've been very successful at consolidating the convenience and fuel marketing space. And through the day, you'll hear that, right? We're not a pure play convenience company. We're not a pure play fuel company. But that opportunity allows us to buy good assets at good value and grow them. And we've done that. Like the video said, we started with one store in Red Deer, Alberta, and now we're in 25 countries. We have a really robust model. It works. We can replicate it across regions. We can build scale, and we can drive value. So that business model, and for those of you who've been part of the Parkland story here for a few years, you've seen this slide. And you know, like anything, like any operating businesses, you don't just snap your finger and create an operating model. This is a model that we have been working on for a decade. And again, fundamental to that model is growth, right? We need to grow the business organically. We shouldn't buy a business if we're not the rightful owner of it and we can't grow it. 90% of our team spends all their time grinding it out day to day, taking those brands and putting them into the market, rolling out programs, connecting with customers, delivering fuel, growing our customer base, and also doing it more efficiently. This is something that we've excelled at, we've gotten good at, and our systems and processes are really focused on it. The second thing is to acquire. So we are a consolidator. We buy businesses, and I'll talk about the skill set we've developed there, but we do it exceptionally well. We grow demand, whether that's in convenience or fuel, and then we push supply. So we basically leverage that scale and push supply and create a flywheel, right? So the bigger we get, the better we get in supply, the more cash we generate. And we have a cash flywheel. We are a compounder. We take that cash and redeploy it in other growth opportunities. So again, and we have a track record of that. You know, our EBIT in the last 5 years has increased by 5 times. In the last decades, you know, based on today's guidance that we put out for next year, that's a 15 times growth. And we can see a runway to continue that growth going forward, and we'll talk about that. And again, you know, produce a tremendous amount of cash to fund the plan, but also we've increased our cash flow per share quite dramatically in the last 5 years. Again, continue to see that. We'll continue to drive that sort of performance going forward. You know, back to that organic growth piece, core to that is our brands, right? 10 years ago, we had one brand. It was called Fast Gas Plus, little independent in the prairies. And you know, core to us is taking these brands and being able to go into local markets and address local offers. And this portfolio of brands has been incredibly valuable to us. You know, for example, we've taken brands that we've bought, great example is On the Run, and made them better. You know, this is a brand that was sort of buried within Exxon, hadn't been invested in for decades. We've taken it and we've created a leading edge consumer convenience brand. Another great example is Ridgeline Lubricants. This was a private label lubricants brand that we picked up in 2018, and we've grown that by close to 400% in 3 years. By taking that and rolling it out into adjacent markets, by extending it, we now have a full line of lubricants that can compete head-to-head with Shell and Mobil. And we've also recently launched a whole renewable product line there. So these are the things, we want to be able to control our destiny. And we can do that ultimately when we control our brands, we control the customer and the customer relationship. And ultimately, that enables us to connect with them. And the big push right now is connect with them digitally. So ultimately, we want every interaction with our customers to be through a digital platform. Journey is a great example of that. Another in-house brand, our loyalty system that we developed, where we recently, in 18 months, we've got 2.5 million participants in that. The growth rate is phenomenal. What does that enable us to do? I mean, it's great. You know, we get loyal customers, they get benefit, but the big benefit to us is the information we get. We can finally see into our customers. We can see what they're buying, we can see when they're buying it, we can see what their demographic is, and we can start to really understand our customer base. I don't know, who here uses Journey? Oh, awesome, great. And you can see things like where we can start to push certain products, certain promotions. And as we continue to evolve that and get better at it, you know, we'll continue to be more focused and make sure that we connect with each and every customer on a personal level. So that's why we like our brands. We want to own the customer relationship. We want to be in control of what we offer. And ultimately, it gives us the freedom to really extract the most value out of that relationship over the long term. So the second thing was acquire prudently and integrate. And again, you know, I look back 10 years ago, we didn't have an M&A team. You know, we would wait for bankers to come and pitch us deal. No offense to the bankers in the audience here. And, you know, and we would rely on bankers to build models and help us negotiate. It didn't really work out well. We kept kind of overpaying and not getting the synergies. And so we built our own team. And again, I talked about Darren and the team he's built. But, you know, there's some core things that we've done there. So first of all is we have our own proprietary pipeline. So of the 50 deals, 90% of those we originated on our own. And as we look forward, one of the things that we've learned is have a broad pipeline. This is an industry that's consolidating. There are lots of businesses for sale. And what we do is we look for lots of opportunities. So we're not beholden to any one opportunity. And there's been a bit of chatter around, well, these guys are just buying anything and they're overpaying. We say no to a lot. And we also look for great businesses that have great value, great brands, great assets, great teams. And that's a fundamental driver for us. And we've continued to demonstrate that we can buy well, we can integrate well, and we can get value out of these businesses. As we look forward, the industry's still very fragmented. Across all of our jurisdictions, there are opportunities. You know, we've done a lot in the US. We recently announced some deals in our international business. And again, there is a large pipeline to continue to grow our base business. Supply. And again, this really underpins our success as a business. So our supply system is really a distribution system. So we like markets that have inefficient distribution and where we can add value. We can add value through our distribution assets, which are truck, ship, rail. We can store product, we can blend product, and we can really add value to our customers from a liability perspective and add value to Parkland from a cost perspective. We basically touch that product 3 times in this value chain, and each time we make money at it. I can very confidently say that nobody else has this capability. And how do I say that? Because every business we buy, all 50 businesses, we're able to add value with this. So it's not like we ever buy a business and go, oh, shoot, we lost money on supply. Our supply platform is second to none. We put business on it, and we get accretion immediately. This is what we call the no-brainer synergy. You don't have to re-engineer anything. You don't have to tell anybody to do anything differently. All you have to do is have to tell the truck driver when he goes to pick up fuel to type in a different number. That's how simple it is. So. And again, that's been fundamental. It's something, when I joined Parkland, we had 2 people in supply. 1 person managing contracts and 1 person managing the distribution fleet. You know, we now have a whole team, and we have optimization experts. We apply a lot of digital in this area to optimize the system. You know, we're basically managing things at a site level on a day-to-day, hour-by-hour, minute-by-minute basis. That's how much we've tuned these systems in. This is our space. We dominate it, and we do exceptionally well at it. So, I've talked about our business model and how it's proven, it works, and we continue to generate value through it. What I'd like to do is talk a bit about some of the fundamentals in our business. And again, how is energy transition going to affect us? What are we worried about? Where do we see opportunities? So I'm just going to take you through a few slides that position that. So at a very high level, what drives our business? Population growth and GDP. And we're in markets that are growing. It's awesome. And what are fundamental to those are people's needs for energy. People need to move. They need to heat their homes. Industry needs to power vehicles. And we're there to service those. Our business owns the customer relationship. That is the most valuable part in the whole value chain, is owning that relationship. And again, the impact of energy transition will be different on these markets, but I can assure you, and you'll see from the data, that we have a really good opportunity in our base business and then some tangential opportunities that present themselves. So when we look at our different portfolio of products and opportunities, we have some really robust growth segments. So we'll talk about fuel, and I'll talk about that on the next slide and break that down for you, because it's mixed. Not all fuel is the same. Not all fuel will experience the same headwinds. In fact, some will experience tailwinds in the short term. And different jurisdictions, it'll be very different. We see opportunities in electric vehicles, which Darren will talk about later. Renewable fuels, which Ryan will talk about, and the opportunity to grow in that space. We're in convenience. Convenience is a high growth segment, and we'll continue to push further and diversify into that. We've got a great position in food. We've got 200 sites across Parkland that service food. We've recognized it as an asset. It's a gem. We're going to get better at it. We're going to have our own branded offers, and we're going to expand it across more segments. And then we have a great digital capability, and the power of digital is phenomenal. We've won projects where we've generated tens of millions of dollars of value by just understanding our data and optimizing around it. It's pretty powerful. So digging more into fuel, and this looks out over the next 10 years, and this is a very recent, like the ink's barely dry on these projections. So this takes into account government's new targets, proclamations around ICE bans. It takes into account substitutes and the technology and the rate of change. And what you can see is, yeah, gasoline in some markets is going to come off. But again, not all markets are equal. That second chart shows our geographic diversification. If you look at a province like BC, it's a leader. They're driving change. But we have other jurisdictions, even in Canada, which will lag that tremendously, or in the US, or down in our international business. And the team will talk a bit about that and how gasoline demand is affected by different markets. But you look at some of these hard to decarbonize fuels, like diesel, jet, LPG, or diesel and jet, they're going to grow across all these jurisdictions over the next decade. The energy density of these fuels is very difficult to replace. You can't replace them with a battery, and the energy density of hydrogen has a long way to go. So again, we see some good opportunities. And again, the beauty of Parkland is geographic diversification, so not all markets will decarbonize at the same rate. And product diversification. We're really fortunate. We're not just a gasoline company. We have these other products where we will see some nice demand growth. So when we look at low carbon and energy transition, and what are some of the things that we're seeing? So this graph on your left, my right, is, there's two key insights in there. One is, if you look at that gray bar that's kind of static, those are ICE vehicles. So that population growth I talked about is going to drive more vehicles. People are going to buy vehicles. But what we're seeing is the growth is actually taken up, certainly in the next decade, by EVs coming into the fleet. And you can see that growth rate. That's the growth rate of EVs to 2030. And again, these are very recent projections. And again, it's interesting. So where do we fit in the EV space? Again, we'll talk about that because we do see opportunity, right? It's interesting. At Parkland, we recently bought a Tesla so that we could start to try it out. And, I was fortunate, got it. I think Scott had it first, and I was able to get it, and I drove it around for months. And I drove it with Ian, and I drove it from Calgary to Vancouver. And some key insights. So when I drive my Volvo XC90, I do that trip. I do it a lot because my daughter lives in Vancouver. And I stop once, and I buy my energy in 120 seconds, right? On the EV, we stopped 4 times, and we spent around 2 to 2.5 hours buying energy. Well, that's an opportunity. Not only will people come more often, but they'll spend more time. And that's our push, push when we start to talk about convenience as a destination. We need to create an environment which isn't there today. A lot of these EV charging spaces are behind malls, or they're in parking lots of hotels. And it's fine in the summer, but in the winter, you'll want to go inside. You want to have some food. You want to be able to relax. You want to have some convenience. So again, we think our existing asset base, which has proven traffic patterns along major highways that people currently use, are well positioned to extend into that. So we made a commitment. We made a commitment to 25 ultra-fast chargers in the BC market to really pilot this and get to understand it. How does it link into our Journey Rewards program? How does the consumer use it? Will they accumulate points on their EV and then use it to buy fuel for their gasoline vehicle? Will they come into our store? Will they collect points in our OOO food offer? So it's a really good opportunity for us to see the adoption and understand how we can build our operating model to accommodate it. We see lots of opportunity in that. On the other side is renewable diesel. And again, one of the pathways to start to decarbonize is actually to use the existing asset base. So renewable fuels are a key opportunity to do that. And again, Ryan will talk about some of the great and innovative work we've been doing at the refinery. We are the only refinery in Canada to actually make renewable hydrocarbons, gasoline, diesel, jet. And we've been doing that, really, when you look at the capital we've invested, it's pretty small compared to a standalone RD plant. And again, Ryan will talk about that. But the demand, you see that big demand-supply gap. I mean, we're in this market. We move renewables, we move them into Canada, we move them into the US, we use our rail fleet, we're in the trading business, we manufacture, and then we're also big in the compliance trading business. So we're in this space, and we see a high growth opportunity to go after it. So when you think of these two and the changes, I mean, we're already in, right? And so it's a logical extension. And then, you know, again, I love this chart. You know, the squiggly line is GDP growth or the economy, and those convenience. Like, what sort of business grows at 4% ratably? I mean, does anybody work for a business that looks like that? I mean, we're in this business, we're really good at it, our On the Run brand is well positioned to grow, and we'll continue to push into this market and create, again, very ratable cash flow through it. So again, we look at the energy transition as an opportunity. We believe that the decarbonization of society will happen. But it'll be different. It'll be different in different regions and in different product lines. You know, our path to success in it leverages our existing asset base and our existing capabilities. So we're well positioned to look at the energy transition as an opportunity, and an opportunity that we're already in, that we're already doing, and we can grow further. So when you wrap that together, I mean, there's really, again, three core components. So the first is what we call develop, which is really our existing business. And that's growing our existing business in demand-resilient markets, right? So I talked about our success as a consolidator and the forward opportunity as a consolidator. We will continue to consolidate. But on top of that, that business gives us opportunity to diversify into convenience destinations. So we talked about larger sites, food, a proper food offer, and a better convenience offer. And the growth rate of that, 25 to 30%. And we can see that, we're seeing it, and we'll deliver that. And then decarbonize, supporting our customers to decarbonize their business, mainly in our commercial business. Again, 40 to 45% growth. So you put that together, I mean, we kind of announced today that we're halfway to $2 billion. So we got another 500 to go, and a big chunk of that is going to be these emerging segments. You start to extrapolate that growth rate out now over to the end of the decade, and all of a sudden that's going to be a third to half of Parkland. So again, how many businesses have this sort of inherent opportunity and this sort of growth rate already in them? And the fundamentals really support that these businesses will grow, and our capability really allows us to go after it and deliver this. So again, you know, the target to $2 billion feels really doable. The opportunity to grow around the energy transition is there, and we're going to run at it. Similar to the way we're leaning into transition opportunities, we need to lean into sustainability. We just released our ESG report, which talks about our commitment to drive to zero. And really that's a commitment to help governments in their efforts to decarbonize, whether that's setting targets for us personally or helping deliver products that have a lower carbon content. And, you know, we're getting recognition. You know, we just got upgraded. I wish that were a credit rating, but it's not. It's our ESG rating just got upgraded by MSCI, and that's basically on the work that we'd done previously. So I expect our new report will start to see more positive momentum among the different agencies that look at this. So again, I think we're well positioned, we're leading, and we're going to lean into it. So again, just to conclude, and I'll turn it over to the team here, but again, this develop piece. So again, we have a proven business model that works, we can deliver value, we're going to lean in and look for conventional markets that have demand-resilient characteristics. And why is that important? Well, it's important because, A, we're good at it. We can generate cash, which will help fund the right-hand side of that. But also, it gives us the customers and the asset base to basically leverage to enable these. So again, what that'll enable us to do is diversify. So we talked about our proprietary brands, continue to grow those, make them better, make them more relevant. food capabilities, whether that's fresh or frozen, connecting with customers digitally, and then ultimately EV charging. And on the decarbonize side, it's basically leaning in and helping our customers. So we have such a diverse commercial customer base. You saw Paul Whitting from Air Canada talk about his needs as a customer. Well, they have pressure. They have pressure that we can help them with renewable jet. We service large municipal clients, or government clients. A great example is BC Ferries. We're able to go to them with a solution that included traditional hydrocarbons, renewables, and carbon offsets so that they can meet their commitments. These are the things that we can do to help our customers, and they'll pay us to do it. And it puts us in the space. So again, renewable fuels manufacturing, compliance and carbon offset marketing. Ryan will talk about it. It is one of the fastest growth areas that we see. And helping our customers look at alternatives for their fleet operation. So again, the left supports the right, and the right is some high growth opportunity. I'm going to turn it over to the team now. So Doug will lead off. Doug, Donna, and Pierre will talk about the develop side and some of the great work they've been doing in their businesses.
Well, thank you, Bob, and thanks everybody for being here today. It's just super exciting to see a room full of live people and not to be staring at a screen for the last year and a half. So thank you for joining us. Thank you for coming out in person and spending time with us today. Really excited to share our story. As Bob mentioned, the three of us are going to cover, to start us off here, really our development plans for the existing businesses, how we see the growth of those coming at us in terms of opportunities, values, and really the continuous runway that's in front of us for those businesses. As Bob mentioned, we are a consolidator of these businesses. We see a long pipeline of opportunities in front of us for continued consolidation at great values. And we do believe that customer base is the key to driving our success in diversification and decarbonization. A couple points on supply, and I know, and Bob hit the high points here in terms of how this drives financial performance for us, which is certainly essential to our business. But I also want to mention that, given the fact that supply chains in the world today are broken all over the place for nearly everything we buy, as many of us have probably personally experienced, I think the days of taking supply chain for granted are going to be tough on some companies. And we want to reassure you guys that we are not one of those companies. We have a great supply chain capability. We're performing for our communities and for our customers reliably, affordably, and with great resilience. This past summer in the U.S., we had months where up to 20–30% of the gas stations in some of our communities across the Rockies were out of fuel. We saw the UK go to the extreme measure of bringing in the Army to transport fuel so their communities wouldn't run out. Our stores were in great shape, right? That supply chain, it's great performance financially, and it's certainly essential to driving that, but it is really important to our core mission of powering journeys and energizing communities, and doing that reliably in ways that our customers can count on us every day to deliver. And it's grown tremendously. We'll talk about that. Pierre will hit some of the highlights of his infrastructure. I'll show you some pictures and some explanations of what we've done in the U.S. The acquisition criteria that we're using, there is tremendous deal flow and consolidation opportunity across the marketplace today. The important thing for us is to be selective and to be very, very focused about the areas where we are confident that we can add value by leveraging the brands and marketing that we have on the top to grow top line, and leveraging the supply capability and the economics on cost side to grow the bottom line. So we're really driving synergies through the businesses on both sides of that P&L, right? Those require us to be quite selective to make sure that we can deploy those and capture those synergies reliably. So supply and efficient markets, I'll show you some depictions of this. The other thing is complex portfolios, and what do we mean by that? Really, it's this. We're buying businesses, and we're going to show you some examples of the last couple of U.S. deals, where they have supply and distribution capability. They have, in the case of the two we just announced in the last few weeks, terminal capabilities, storage terminals. They have trucking, distribution. They have a commercial business. They're servicing the industrial commercial base in their communities not just the consumer at the retail site. And they're providing a holistic, exposure to that customer base in the whole community. And in places in particular where there are supply and efficient markets, it creates unique value for that company. It really creates unique value for us because we add value to each one of those product lines. We're good at lubricants, we're good at propane, we're good at diesel, and we're also great on the corner store, right? And that positions us very, very differently to exercise and to execute on this consolidation opportunity because we're not forced into banker-led deals that are at auction and driven up in values to multiples that, quite frankly, don't make sense to us. We don't have to do those deals, and we don't. And we've proven, as Bob mentioned, we 10x the U.S. business. We think it's a great start. We've certainly gone from being immaterial to being part of the game now, and we're excited about that. But again, we see a tremendous pipeline of opportunities in front of us in the markets that match us the best to continue to doubling and growing this business going forward, right? So when we look at that opportunity, the important thing is, again, not to get drug into unaffordable deals, and we don't need to, right? We can transact at 6 to 8 times multiples all day long in this business and continue to drive synergies and accretion beyond that purchase price, and we can do that ratably for years. That's the size and scale and scope of the pipeline that's available to us, and we do not see values inflating like they have in the pure retail plays that have been highly competed for at auction. A couple examples of those. We announced Lynch Oil last week. Hits all the boxes for us. The fuel demand in Idaho in the last 10 years has doubled. The infrastructure has not, and no one's going to build another pipeline these days, right? So the fact that, when we'll talk about C&B in a moment, that we bought earlier in the year, these family businesses saw that challenge of servicing and providing supply for their communities. They built rail terminals to solve that problem. They're now in our portfolio, and they're connected to our supply system where we have the scale and the logistics and the risk management capabilities to operate them far more profitably than these companies did when we bought them, right? And this is the picture on the right there is the travel center for Lynch Oil. Tremendous destination. And when we talk about creating destinations for travelers, this is the center of this community, right? There's a food court with multiple food offerings, multiple brands, multiple different, from tacos to pizza to chicken, you name it, all in one place. There's tremendous opportunities for the industrial side. You can see all the trucks parked behind it. As the growing transportation demand in this market, and all the way up on the hill behind it is actually their 2 million gallons of storage rail-fed facility that they use to not only supply this site, but they had 8 other sites that we picked up in this transaction we announced last week. Now, how does that fit with previous activity? So we announced C&B in April. This is a business that we acquired coming into summer. It pro forma'd out at like $2.5 million a month. By summer, we were running it making $5 million a month. So the opportunities for us to create synergies, the speed at which we can do that, and the reliability at which we can capture those in these types of transactions is now a really proven capability for the U.S. that we can build on from here. And like I said, that doesn't mean that the success of our strategy requires us to be precise, to be focused in the markets where we want to grow, and to make sure those markets hit that criteria that we mentioned earlier, and that the value entry points that we get coming in are affordable for us. But when we find that mix, we will act quickly, we'll act decisively, and we'll be the first ones in the market to be able to take advantage of those opportunities as they come. I mentioned Lynch Oil. Like, that business normally wouldn't have come to market till 24 or 25. We've had a wave of activity that was driven by the tax uncertainty that's present in the U.S. right now. But our abilities through Darren's team and the corporate development folks to be able to act quickly, decisively, and to have a great reputation in the marketplace with these sellers has allowed us to exclusively originate all the 20 deals that we've done in the U.S. over the last 4 years. Completely exclusive, originated by us, for us, by our teams, and executed by our people. So it's a great opportunity to create value. The C&B business, as an example, is just an incredible earnings engine I think will grow for decades to come. And really allow us to drive the diversification that Don is going to talk about in particular with food and retail, because the retail networks attached to these are some of the best in these markets. The largest sites, the best corners, tremendous infrastructure, but not connected to the supply infrastructure that we have at scale nor not connected to the retail and branding programs that we have on the sales side. So we really want to add value on both sides of the businesses. You know, when we look at the consolidation opportunity beyond these, I want to be clear with everybody. For the states that we're in now, we can build another Parkland right there. We don't need to go into the other states where these unique filters that allow us to create value in our own Parkland way may not exist. We don't need to go into California. We don't need to go into Texas. We don't need to go in New England. And we have no plans to do so. We have enough opportunity in the markets where we're in and proven and base loaded today to double the entire company going forward without going outside of those. So I just don't want anybody to feel like, oh, they're just running around hunting, you know, anything that comes at them. No, we say no 95% of the time. But the 5% that matches our needs is really golden opportunities for us to create really strong accretion for very long periods of time. As we look at, I'll go back real quick. It is important to note that I think part of what's driving the difference in valuations is that if you're a pure play retail consolidator and you want to add scale and you've already got thousands of stores, to go find chains that have thousands of stores, there's not very many. Right? Most of the opportunity in the 150,000 stores across the US is stores like Lynch that we bought last week. They had 8. Now those 8 sites do the volume and throughput and productivity of probably 24 average stores, so they're better than average, but you still have to be able to get to that level of the business and do those transactions successfully at great values if you want to continue to consolidate successfully. And that's what we're geared to do. That's the team's focus, and we've got the people to execute well in that area. A few words about Urbaneda. We announced this, I think it was the same day we put out earnings, so we did cover it a little bit on the earnings call. We promised to provide a bit more information, which I wanted to follow through on today. You know, a really great platform and launch pad for us in Florida. You know, we invested in Tropic Oil in 2019, right before the pandemic, which was, you know, not ideal given the cruise ship service that we did there. So it's been a lot of hard work over the last year and a half to position that business successfully, which we've done. The headquarters for Tropic is 500 yards from the Urbaneda headquarters. These teams know each other. The families know each other. It's a tremendous chance to put together the supply and distribution and transportation capabilities that are present in Tropic, attach those to a really great retail business, and create synergies very, very quickly in this business. The other thing we really like about this portfolio is the site density. So we get 94 stores in 2 counties very, very close to each other. So as we look at launching On the Run in the US and continuing to expand it in new markets like this, this gives us that core scale and density that we need to get the brand launched successfully, get good returns on advertising, marketing, loyalty in a dense market where we can deploy successfully in one spot and build from there at good values and with tremendous infrastructure. You know, what the Urbaneda family, which has joined us in this effort, you know, took some shares along the way to be working with us going forward. We're excited about their ability to help us succeed in that and their expertise in real estate and site development that has driven this network success. What they didn't have expertise in was supply and marketing and branding. So you can see where you take their infrastructure, their assets, their real estate expertise, you combine it with what we're really good at, and it gives us a tremendous launch point for Florida. And Florida is now really the largest addressable market that we're in. There's almost 10,000 C-stores in Florida alone. And all the other attributes that we mentioned in terms of really getting excited about the filters that we mentioned, right? Very hard to supply. There's no pipelines into Florida, and there never will be. This is a waterborne market supplied with ships and barges, something that we have gotten very, very good at in terms of operating Sol. So it's a chance to take that supply capability, which is pretty unique, deploy it in a rapidly growing market that's got the backdrops that we like, very rapid population growth. I mean, what's happening in the US with, you know, it seems like everybody in the Northeast moving to Florida. It's unbelievable the amount of construction and new neighborhoods, new communities, new stores that are needed to service these customers, right? So we like the growth trajectory, we like the governance that's there, we like the supply dynamics that we're uniquely positioned to take advantage of, and we're able to do it in a very, very large market that gives us a tremendous runway going forward. So with that, I'll hand it over to Pierre to talk about international. Appreciate you guys spending time with us today.
Well, good afternoon, or good morning, everyone. My name is Pierre Magnan. I'm the president of Parkland International. We proudly do business in the Caribbean and in South America as Sol. And across the region, we fly 3 brands in retail. Our own proprietary brand, Sol, Esso in many markets, as well as Shell in the Spanish Caribbean, as well as in South America. It's a privilege to be here today to tell you a little bit about our business. I will talk about the journey since closing, so we're coming up on 3 years. I'll tell you what we really like about the business, some of the challenges that we've had, and where we're going, what the future looks like in the international segment. Very, very briefly, and actually before I begin, I want to say that today is a special day at Sol and the Parkland International business because we're celebrating 1,000 days without a lost time incident. So it's a big anniversary for us. It's something that we celebrate. And we do take enormous pride in safely and reliably supporting our communities and our countries as their provider of choice in fuels and as the leading distributor in the region. And I say that because one of the key differentiators at Sol and Parkland International is that we really do provide a vital public service. So in addition to our robust retail network, our commercial business, we have a power segment and an aviation segment, which is market leading across the region. So we're supporting electricity to homes through our fuel supply, increasingly also through renewables. We're providing power to desalination companies and energy solutions. So it's a responsibility we take seriously, and our license to operate is really around that safety and environmental stewardship in pristine environments that we take a high level of pride in. So I want to congratulate the team for 1,000 days without a lost time incident, and highlight that responsibility that we take. So what has happened these past 3 years? How have we been? What I'd say is that the business has exceeded our expectations as well as our investment case. And when you look at that small COVID adjustment, what we've done there is we've said, okay, well, what was the volume from 2019 that we've lost and that has yet to come back? And that represents about $25 million of margin. So we're expecting that to come back over time, but normalizing for that, this has been an incredibly robust business that we have continued to grow through COVID. Now, we've had to grow in different areas. We've expanded our customer base in commercial. We've rolled out programs including Journey Rewards in Barbados, where we now have 16,000 active members. Now, that doesn't seem as impressive compared to the 2.5 million in Canada, but on a percentage of population basis, this is a very significant achievement for the team and one that we celebrated just last week. If you look at the $50 million of synergy capture and organic growth that we've been able to develop on a run rate basis, that has been in some new areas of business in addition to the base retail and commercial. We've expanded significantly in our supply and logistics capability. So we've been able to add sophistication and process so that we can more efficiently meet the different fuel specifications of the 23 markets in which we do business, and also adjacent markets. So we've really developed a wholesale fuel supply business, which is waterborne. In addition, in LPG, we've developed a supply capability that Sol did not have. So we've added ships, we've added origination and trading capability and risk management around our LPG. And most importantly, across the board, we've really invested in our sales capability. So what we love about this business, and it really is a lattice work of relationships across the 23 markets, is, number one, we have an unbelievable team that's very experienced, people who have grown up in the region, in the industry, dozens of engineers who know these assets and who know the markets and who work in the communities that they serve. So we believe in decision-making as close as possible to the customer and to the community. So our team is really at the heart of our competitive advantage, one Parkland team. But that is supported by customers across different channels and across different verticals. Many of them share common traits, so we have expertise in serving power customers across the region, in lubricants, in fuel, in LPG. We have expertise in hospitality, so you think about the hotel chains, our network of aviation facilities, and we've just proudly added Puerto Rico, small acquisition, but the network effects of adding aviation locations in the Caribbean are considerable. So as we add locations, we can serve our regional customers more effectively. The same is true with hospitality. As hotels get built, we become the partner of choice for our hotel customers. On the marine side, we have a very close collaboration with Tropic and Parkland USA. And thanks to the strength of their relationships with the cruise line industry, we've been able to expand that business. So these have been sources of strength. Now, when the recovery returns, and the recovery has been delayed a little bit in the region because the vaccine efficiency and the vaccine penetrations we're lagging North America a little bit, but that should provide a significant tailwind as tourism returns to the region. So we have, I believe, a very strong competitive advantage in terms of the diversity of our customers, of our regional and local relationships, the way we serve them, and across business lines. So it's very well diversified, as I've mentioned before. We've really grown wholesale and LPG through the pandemic these last 2 years, and we're developing a renewable offer, which we're very excited about. And that's really around, as Bob and Doug have previously discussed, how do we serve our commercial customers better? And in our region, that means some rooftop solar and some renewable fuels as they seek to tackle the energy transition. Our key competitive advantage, and I'll touch on this briefly, and it's one where we have invested significantly, is the supply advantage. So this sounds a lot like what we do in Canada and the US, in the sense that we have our proprietary import terminals, really is the backbone of the business. And the connective tissue of this lattice work of infrastructure is really our shipping fleet. So we do have a very efficient, sophisticated team that manage the logistics, and most of our origination is from the US Gulf Coast. We bring in supply from the US Gulf Coast, occasionally from Europe when the ARBs are open, into our intermediate storage. So we have a few million barrels of intermediate storage where we blend and where we optimize to meet the different specifications of the 23 markets. And then we have a smaller fleet of 10 chem-class size vessels that do the milk runs to the markets. And freight is expensive. It's a significant cost, but it's also a source of competitive advantage because it's difficult to replicate the efficiency that we have in terms of eliminating dead freight and really running an efficient milk run. And so for new entrants to the region, it's difficult to have that lowest cost to serve that we can reliably provide to our customers. So the logistics, the supply advantage, leveraging the relationships that Ryan and the US team have with our refining partners has become a very important differentiator for us in the region. When we look at across the region, and like Canada and the US, we are divided into regional operating centers, and at SOL we have 5. There's a beautiful diversity here, and I want to highlight some of the drivers of each of these markets. But importantly, and unlike Canada and the US, we have very, very strong GDP growth and projected fuel demand over the next decade. So the rate of renewable adoption will be different in the region. It will come eventually, but we're expecting robust demand for the next 10 years and well beyond. So when you look across the portfolio, we're generating ROICs of north of 15%, cash flow north of 50%. So we have very strong cash conversion, but it looks different by rock. And I'll take the Western Caribbean as an example. The GDP per capita in the Western Caribbean is similar to the US or Canada. So these are stable markets. They have returns that look North American. Tourist-driven, balanced economies. Similarly, the French Caribbean has European market attributes. Also tourist-driven, but with diversified local economies. We get attractive returns, but low teens. Whereas in South America and the Spanish Caribbean, you may have read that Guyana is the source of massive resource development. The Exxon finds over 10 billion barrels of oil in place. We're supporting that ecosystem with the offshore. So we have a massive marine diesel supply business based in Guyana, and the GDP growth in that market alone is over 50% next year. So we're benefiting from strong GDP and commercial tailwinds in South America. The same is true in Suriname. Suriname is about 3 to 5 years behind Guyana in terms of the energy industry. And in both of those markets, there's a robust mining industry that we supply. So again, that's diesel and lubricants. So these are higher return, more volatile, higher growth markets where we're investing significantly on the infrastructure side to be able to support the growth of the industry for the long term. In the East Caribbean is a mature market. That is, it is our most tourism-exposed rock. And so that is the area where we're expecting the biggest uptick when tourism returns. But heavily retail and aviation focused in those markets. So they all have different strengths. They all have different customer bases and different drivers. But together, the portfolio provides a source of resilience, and it has helped us remain stable and profitable and growing throughout COVID. I want to spotlight one example of a retail development and one of our recent investments on the M&A side, an aviation example, and talk about our infrastructure. So a bit of a deeper dive here. Isla is a recent partnership in the Dominican Republic, and this is our playbook for M&A in the region. The Dominican Republic needed to be consolidated as a market. We found a great partner, and we've created the leading retail network in the region. That's an onshore partnership, but offshore, Sol, Parkland continue to supply the joint business. So an amazing synergy. We've exceeded investment case, and we've captured the synergy within a few months. This is an example, and I'm short on time, so this is an example of our import infrastructure in Guyana. And last but not least, this is an aviation facility in Bermuda that we have just commissioned, proudly commissioned. And this is an example of a generational asset. In the top left blue box, you can see our import terminal, where we have one of our fortress import terminals. It's linked by pipeline to the airport, and we're the exclusive supplier of aviation fuel and proudly serve the people of Bermuda and its tourists at this beautiful new facility. So a few examples. I'm sorry I went over, Donna. Over to you.
Great, thanks. Good morning. I'm Donna Sanker, and I'm the president of our Canadian business. You heard Bob, don't judge me that I moved from Southern California to Calgary, but they did such a good job of selling me on the amazing Parkland story that I couldn't help but come and join the company. So I'd like to talk to you a bit about our Canadian business and the amazing story of how this business has grown. You heard Bob mention that we started off with one gas station. Our retail business today, once the acquisition of Crevier is complete, will be almost 2,000 stores. And what's interesting is that 84% of Canadians live within a 15-minute drive of a Parkland station, so we have built quite a network. Our commercial business, 230 cardlock locations and bulk plants. We deliver diesel, propane, gasoline, we sell lubricants, and we do furnace oil as well. And so we've got a big, excellent commercial business, again, from coast to coast, just like our retail business. And so as you can see on the chart here, we have spent the early part of this period doing acquisitions. We then were focused on integration and making sure we delivered the synergies, and then really focusing hard on organic growth. Despite, a bumpy road with COVID, the business has really come through strong, and we're on track to deliver $445 million of adjusted EBITDA this year. So we've built this wonderful foundation. How are we going to grow it in the coming years? And so we have several key areas of focus. The first is, we filled in the network quite nicely across the country, and so we are going to be focused on what we call demand-resilient micro markets, or pockets, where we see good population growth, we can get some good density out of there, the outlook for the fuel demand looks good, and so that we will be very selective about how we invest in small pockets of markets. Our retail and convenience business. Boy, this business did fantastic during the pandemic, and so we see a long runway for the business, and so we will continue to invest in that part. Our food business. So you hear about Triple O's. I think you have a nice gift card on your table. Sorry for those on the phone that you won't get to partake, but as we have invested in food, we are seeing that this is a very viable and good way to drive traffic to the sites to grow our profitability, and so we will continue, and Ian will talk to you about that a little bit later this morning. Propane and diesel. If you saw the outlook for what the growth is and the demand for these products, this will be our area of focus for our commercial business, because there is definitely some good runway for us to build. And I'd like to mention Burnaby. So our Burnaby refinery, this has a unique location that, when coupled with our supply infrastructure and our marketing business, together that integrated value chain is very, very good for Parkland. And so we will continue to invest in that orbit because we see lots of upside there. On supply infrastructure, you saw Doug's map, and he showed how we have built really good supply infrastructure across Canada. What we intend to do is invest where it makes sense to build in, and if we need to improve our optionality around supplying our marketing and our wholesale businesses, that's where we will focus our efforts. And then last but not least, and you'll hear from Darren, you heard a little bit about Bob's story, EV charging, and we're very excited for the launch of our network next year in British Columbia that will take us from Calgary all the way to Vancouver. So these will be the areas of focus for our growth. And now what I'd like to do is drill in a little bit and talk to you about retail. The chart on the left that you see here shows, an interesting trend of what's happened to the Canadian retail business over time. Back in the early 1990s, there were 22,000 gas stations in Canada, and the average throughput was 1.6 million liters per site. And what you see has happened over the last 30 years is that the number of sites have been rationalizing, but the average throughput per site has increased by 40% to 3.8 million liters per site. And so what we believe is happening is that the best sites on the best corners are the ones that are going to be most successful. And so that's really where we are focusing our efforts in the retail business, is around making sure that we have the best locations and that they have the best offers. And so you can see here how we're thinking about this and what we have focused on. The first is responding to evolving customer preferences, and I'm going to show you an example in a minute of how we take this and put it into practice. We also can improve the site offer, and again, I'll show you in my example how we do that by adding amenities, adding a convenience store, adding a QSR or Triple O's as an example to really elevate the site offer. We have invested a lot of money and effort into our digital capabilities to make sure that we can manage the margin and the pricing in our sites to be able to get as much out of them as we can. And then the last area is really around network development. And we have this big network of sites, but what we do on a regular basis is we go through and review our portfolio, every single site, and we rank them based on criteria, including how they currently perform, what their offer is, what's the population, what's the competitive intensity around that site, and we rank all of our sites, and then we manage it as a portfolio. And so as you can see across the top here, the way that works is that we are optimizing the portfolio. And our best sites we're investing in, and our bottom sites, you know, there's a churn, a normal way you manage the portfolio, and so we divest those sites and basically are taking our network and going, we've gone in 2018 from 60% of our network being top tier with plans to get to 80% by 2025. So if you look at the pictures on the bottom here, just a quick example. This is a site in British Columbia, and you can see on the left, this was a site that had 3 maintenance bays, and it was a bit old and tired looking. And so if you think about evolving customer preferences, you know, customers don't really want a maintenance bay at a gas station anymore. So we knocked it down, we put in a convenience store and a triple O's, and the site has done some incredible lift since we installed this. And so we looked at the site 12 months before construction, 12 months after construction. We got a 54% lift in volume, 100% lift in our C-store sales. Food went from 0 to hero because we didn't have food, and the overall EBITDA increased by over 80%. And so this is how we are high grading the network and thinking about, you know, how to get more out of our sites. So to wrap up the development section here, this is developing our existing business. You heard a great presentation from Doug on how we're going to continue to consolidate. We are also going to continue to press hard on the organic growth, and we see that this section, this pillar of our business is going to deliver $400 million of EBITDA over the next 5 years to get us on that path to $2 billion, sorry. Okay, so with that, I am going to turn it over to Ian, and he is going to kick off the next section, which is around how we're going to diversify our retail network. So with that, over to you, Ian.
Morning. It is great. I just want to echo my colleagues' comments about how great it is to see everyone in person, especially for the marketing guy who gets to, you know, set up gondolas in front and have you see all the great products and services that we continue to grow and expand across all of our geographies, the 25 countries that we serve today. So my name is Ian White. I lead our marketing and innovation group, and it's been a fun journey for me, literally, being here over 7 years now, from a regional player to now an international player, and one that has, as Bob alluded to, just so many products and services and brands that we're so proud of and continue to support and grow. So one of the things I wanted to cover off today is the fact that, you know, we're in the retail business today, and we do a terrific job. And this diversification play is really one of acceleration, and one that we believe is essentially a no-brainer for Parkland because of the customers that we see day in and day out. So let's just put something in perspective for a minute. We serve roughly 1 million customers, actually north of that, a day. So that works out to 12 customers a second. So the math I did in my head, and I always like to convey in terms of giving you a perspective on the magnitude and the opportunity, is the fact that by the time we leave this room, we will have served across all of our geographies greater than the population of Whitby, Ontario, which is just east here of the city. That is, by the way, growing as well. So when you've got a business that has that type of transactional intensity and serves that many customers day in, day out, you've got a tremendous opportunity to be even stickier with those customers and to continue to grow your relationship with them and ultimately contribution. So we believe that convenience is resilient. And not only is it resilient and do we believe it, we actually saw it through COVID. We saw the need for fill-in trips, the need for customers to go to our locations, and especially in those smaller communities where we are the one-stop shop for them, where we are trusted, where we've got a brand that they trust and a team that they know. We've got that local feel and presence. So the thing I love about the business, having been in retail for some time, these are 3,000 to 4,000 square foot stores that are at the corner of Main and Main in these communities that in 4 weeks can be transformed as customers require us to do so. And that is a massive opportunity. One that, you know, not just the intensity of the customer relationship and in terms of the interaction that happens, but also this tremendous asset base that we can transform literally on a moment's notice. So a great opportunity for us. The second one is the need to just accelerate, as I talked about. So what we're talking about here is not new to Parkland, but what we want to do is step on the gas, so to speak, around food and convenience, so customers think about us as a destination for that beyond their energy needs. So we think there's a big opportunity there. And then the third one is, I always like the twofers, right? Where not only if we do this and do it well, and when we do it well, it will not just benefit the business today, but it also helps us evolve to the future as customers' energy transition requirements take place. So that the trip that Bob and I did, as a for instance, we did see different activities and experienced it, differently through the lens of an emerging EV customer, as an example. What we wanted was a place to stop and actually eat and literally fill up ourselves with energy, but also our vehicles. So there's a tremendous opportunity to fill both needs in terms of our traditional customer, but also the emerging customer. So speaking of customer, we've done a lot of work on this. And when you serve 25 geographies, you have to make sure that you know the customer. But what's interesting is that irrespective of the geography, we boiled it down to 4 main customer types. Okay? And they're shown here on the screen. We did a little bit of a different survey because we wanted to understand the interaction between our forecourt business and our backcourt business, so the fuel business and the C-store business. And what we found is, irrespective of the geography, there were really sort of 4 core customer types. I just wanted to highlight them very quickly. So our on-the-go refuelers and our premium pit stoppers are our most valuable segments. Their spend with us is more than half. It accounts for roughly 60% or so of our total spend across our customer base. They're the ones that we value. So when we think about who we target, where we spend our marketing dollars, these are customers, the pit stoppers as an example. They love our C-store business. They buy premium fuel. Feels like a really good opportunity for us to continue to improve and increase our connection with them. The on-the-go refuelers, busy family life, needed to go to and from locations. They need some help along the way. They need us to help them make the most of every stop. So again, an opportunity for us to make sure that we're targeting the right demographic and the right customer base. The freewheeling pragmatists and the frugal drivers, they're more value-based. So let's not overspend there. Let's make sure we're there for them when they need us. Let's make sure we're priced effectively. Let's make sure we've got the right type of promotions. But most importantly, let's make sure that that's targeted and we're not giving away margin where we don't need to, but we're also making sure that we're, again, targeting the right customers at the right point in their journeys. And the brand portfolio that we've got allows us to do just that. So this is our existing customer base today, but we've also looked ahead and said, what's going to happen? How do we see their needs evolving? And what's happening is customers continue to tell us they want choice. They don't want to be overwhelmed with choice, but they want to be able to do business with us that's in a way that's convenient for them. So that's the products and services that we offer, so things like evolving to food, and I'll talk about that, but also our digital interaction so that we remove friction from the experience. So again, we're looking at who we are today and who we are with our customers today, but also with a very clear perspective on where we need to be in the future to meet their evolving needs. So Bob showed this slide. The marketing guy has to also show it because we're really proud of the brands and the portfolio that we've been able to pull together over the last number of years. And it is a combination of proprietary brands, partner brands, and exclusive brands. But where we're spending the most effort currently, and Bob alluded to it, is our proprietary portfolio where we own the customer, where we know who they are, we interact with them, and we're able to make those personal connections. And we've taken some time and we've made investments in Journey that I'll speak to in a little bit, but also the fact that private label. And those of you who, again, came into the room this morning, you saw we've got 2 full gondolas of great 59th Street and cargo private label products and Ridgeline. So again, those are unique and proprietary to Parkland. They're a national brand quality, but through a Parkland branded offer. which allows us improved margin and again allows us control over supply chain to manage our own destiny and also to start using those products in and around our Journey program to again grow and build that customer relationship. So we're really excited about the momentum that we're seeing with our brands and the connection that we can make with those brands directly to our customers. So one of the things that, when Donna comes back up, and Darren as well, is this is a sum of all parts game. So it isn't just about having the best offer, it's not just about having the best brand, it's about how all of these things come together to form a unique and differentiated value proposition. So there are three components that, again, we'll sort of tag team here over the next few minutes and talk to you about, but I just wanted to highlight them quickly. So proprietary brands. You're going to hear it over and over again, but worth reinforcing. That's where we're investing our time and effort to, again, ensure that we've got that customer connection, and that ultimately leads to improved site productivity. This aspect of food, and again, I'll come back after we show you a quick video and talk more specifically about the role of food, but we believe food plays, and we already see it in our business today, a critical component of, again, making sure that we're meeting customers' needs through day parts and breakfast, lunch, dinner, snack occasions, but also ensuring that we've got an opportunity to build and grow productivity metrics through improved margin and points of differentiation. So a big opportunity there. And then also this aspect of digital. And we haven't talked a lot about digital. I will here in a few minutes give you some highlights of some of the things we're seeing with our Journey Rewards program, how we're starting to shift towards a personalization engine, again, that is proprietary to Parkland, and the engine that we're building to, again, make that connection to our customer to ensure that we're their first choice when it comes to convenience, retail, and their energy needs. So the team and I have spent a lot of time thinking about the future and thinking about what an experience needs to look like and how it needs to evolve, again, in order for us to be differentiated in this space. And we've taken a two-pronged approach. We've looked way in the future, and in order to do that, we've partnered with an organization called Electric Autonomy that we announced a little earlier in the year, where we're the leading sponsor and provider of the retail station of the future. And we've got dozens and dozens of applicants that have submitted design elements to allow us to reimagine the convenience experience through the lens of an EV driver. So we're working with them directly on that. I'm actually part of the judging panel. We've partnered with CIBC, our banking partner, through Journey on that as well. And we're really excited about what will come out of that and the type of innovation that we'll see as a result of a blank sheet approach when it comes to setting convenience as a destination for the emerging EV driver. The second thing that we've done that's more real time is how do we evolve our existing offer to ensure that we're kind of in the next generation of store design and build. So what I've got, and I'm going to roll here in a minute, is a video to give you an idea of our thought process. What I ask the audience to consider is that look at the brands and look at the experience and recognize that we do have a lab store set up in Calgary where we're testing some of this logic. You'll see some of this deployed en masse, but a big part of what I wanted to indicate to the audience today is that we're thinking about how the customer experience needs to evolve, and these are some of the things that we're contemplating in terms of bringing it to the market. So, and then after that, we'll ask Donna to come up and speak a little bit to the deployment of some of this activity, and also to Darren as well to talk through the emerging EV customers. So let's roll the video, please.
As the future unfolds, On the Run will play an important role in customers' lives, serving as a mobility solution provider for wherever their journey may take them. An innovative, personalized experience with products and services that meet the evolving needs of our customers is at the foundation of On the Run, allowing them to make the most of every stop. Offering an unparalleled brand experience, our new store concept will captivate customers before they even enter the door. with state-of-the-art equipment to power their journeys. EV chargers and fuel dispensers will enable quick and frictionless mobile payments integrated with the Journey Rewards program, and offer advertising features and food ordering capabilities perfect for EV vehicle owners wanting to grab a bite while their vehicle charges. Further elevating the experience, license plate recognition will enable customers to begin fueling or charging the moment they arrive. This technology also allows for personalized messaging and offers based on robust purchase history data, available through the Journey Rewards personalization engine. The store itself will be a contemporary and high-quality build, with designated parking stalls for customers who order ahead and a separate area for food delivery drivers. Stores will also feature a convenient drive-through option for on-the-go travelers. Once inside, customers will be greeted by captivating digital screens on cooler doors that will feature exciting promotions and messaging, which can be personalized based on each customer's purchase history. Store layouts will include dedicated areas for innovation and cross-promotions to enable a more convenient shopping experience they will tell their friends about. Self-checkout options will allow customers to shop at their own pace. Well-maintained, family-friendly washrooms will be fitted with clean and convenient no-touch dispensers and fixtures. A welcoming and comfortable seating area with free Wi-Fi will provide customers with a place to eat, connect virtually, or just relax while their vehicles charge. Customers can treat themselves to delicious meals courtesy of our branded restaurant concept that will utilize a ghost kitchen to efficiently prepare a variety of food items, such as burgers, fries, chicken, pizza, and tacos based on regional preference. Contactless, just-walk-out payment technology, enabled by our Journey Rewards platform, will allow customers to pay effortlessly and get on with their busy day. Welcome to the future of convenience. Welcome to On the Run.
Hello again, and now I'm back to talk to you about how we're going to grow our On the Run convenience brand. We're going to do it through a couple different ways. The first is I want to talk to you about how we are focusing on improving our site productivity across the entire network. The Canadian retail team has been hard at work on this over the last couple years, and you can see it's delivering the goods. If you look at the total C-store gross margin, we've improved it by $55 million over the last couple of years. And so how are we doing that? The first area is around our analytics and performance management. You may have heard the expression, retail is detail. You may also have heard the expression that what gets measured gets managed. And I'm here to tell you that both of those are true. And we are seeing the fruits of that effort, and as we've really dialed up our analytics and our performance management. We've also been implementing a number of new programs. We launched in the last year and a half C-store delivery through Skip the Dishes and DoorDash. Obviously during COVID, that was quite material, and we saw a big lift from that. We've launched a Food for Later frozen food program at our C-stores, and we've recently just launched a new coffee program. The next thing that we're working on, in the convenience store business, there's a bit of a science behind what happens in the convenience store. From which products do you carry, how many do you carry, how much inventory do you have to have, and so there's a whole set of tools we call planograms and layouts, and we have been hard at work this year digitizing all of those tools, and we think it's going to deliver big in the coming years and help us again in that area of analytics and performance management. And then last, and probably the most important, is actually the operations execution and what happens at the store. We can design the best programs in the office, but if they don't get executed properly at the customer, where the cold face or where the cashiers and customer service reps are interacting with the customers, then we've missed the boat. And so we focus a lot on how we are executing at the site. And all of this is helping us deliver and improve the performance across all of our network. The next way in which we're going to be growing our on-the-run business is we're going to be adding standalone convenience stores, and we've actually got several of them lined up to launch in the first half of next year in Vancouver. What is a standalone? A standalone is basically a convenience store without fuel. And so you might see this in a downtown area, you might see it in a strip mall. And so this is a tried and true way for us to go to market with our convenience store on the Run brand. And so we'll be launching that with the intention of getting 50 sites by 2025. In addition to what this will do, we'll be able to target walk-up and neighborhood customers with high traffic locations, and it will also allow us to improve and increase the engagement with our Journey Rewards program. And so we see some good upside with the standalone business. And then last, but certainly not least, is we intend to build significant scale with our On the Run brand. And you've been hearing us talk about it. We've been adding and converting our existing network. But really, by 2025, we intend to have over 1,000 on-the-run locations across North America. And we'll do this through a couple different routes. The first, you can see sort of the bars or the buildup of how we get there. First is through our company-owned network. But then also, just this year, we have just launched a dealer on-the-run offer so that our dealers can also be part of On the Run, and it will also increase our stickiness with our dealers. So there'll be a piece of company network, a piece of the dealer network, and then you can see that standalone stacked on top to get us to 1,000 sites by 2025. So that's how we intend to grow with On the Run. Now I'm going to hand it back to Ian, and he's going to talk to you about how we're going to build on the success we've already started with food. So Ian, over to you.
Okay, Donna, thank you. I alluded to it earlier, but I just wanted to highlight the fact that food is a natural adjacency in the C-store business. It is one that we're already in, and it is one that we're quite successful in as well. Bob spoke to it earlier, but just to reiterate, we're in already over 200, roughly 200 or so locations in Canada with various types of food offers, and almost 75% of the US, our US locations have food as well. So this is a natural, and also a number of Sol locations. So this is a natural adjacency for us. And what's up on the chart here, or up on the screen, is just an example of the productivity improvements we see when we add food to our portfolio in the C-store business. And this is a relationship that we have with Triple O's. It is exclusive to Parkland. It is unique. And you can see what it generates when we do it, and we do it well. So we're very excited about food and about continuing to pursue food, but doing it even more aggressively. Back to the day parts, I just want to spend a little bit of time on this to sort of articulate what's on the slide, is that we believe that day parts and breakfast, lunch, dinner, and also the snacking area that we're well covered in are critical components of the day that we need to cover, again, in order to be a destination for our customers. And it's as simple as, depending on what side of the street you're on, right? If you're on the drive-in, in a commuter community, really any community to work, then we need to be strong in that sort of, that morning day part, versus on the way home, we'll lean in a little bit more to the afternoon and the evening day part. But what matters the most is that there is a level of quality. And I still remember, now 4 or so, I guess almost 5 years ago, when we bought the On the Run business here in Canada and bought the franchise business, but also the brand, and began to really dig into the research and understand what customers wanted. There were 2 key things, and I think I spoke to it at our last Investor Day, but just to maybe reiterate. One was the brand was tired, it hadn't been invested in it some time, and needed to be revitalized. So we listened to that, and we re-imaged the logo and spent some time on just the decor and the look and feel. The second one, though, that was really important was that customers wanted better quality. Okay? and recognizing that there is a move to plant-based and there is a level of enthusiasm around sort of eating habits, we believe that there is an opportunity for us to offer and a need for us to offer a high-quality, fresh food offer in the most efficient way possible. And when you see the growth in food and you look at core categories like burger or beef through burgers, chicken, tacos, pizza, those are areas that we're very focused on and have the greatest trajectory in terms of user acceptance or what customers are looking for across virtually all of our geographies. So the way in which we're going to deploy that is through three methods. One is a made fresh method, and that's our typical sort of quick serve restaurant partnership. So Triple O's is a good example where we've invested in the infrastructure in that location. We have the density to support it. We've got the customer base that loves the brand. And the natural extension there is to build more of those locations where it makes sense and to start connecting our rewards program and again, even stronger forecourt to backcourt conversion. The second opportunity for us is a fresh from frozen concept that we are in the process of investigating, where again, to the customer, the taste and the quality is light fresh, but the efficiency for us is around wastage and spoilage, and to have a frozen opportunity that can be defrosted and thawed at location and then presented fresh in that particular day part. And the third is frozen, and again, an area that we've had some success with, and that's more of a take-home home meal replacement option as well. So there are key day parts that I guess want to leave you with, key day parts that we want to be able to pursue, that we are currently pursuing in our base business and that we want to accelerate through these different methodologies. So how do we do that? And listen, this is something we've spent a lot of time on and spent a lot of energy around internally to sort for what is the most efficient way for us to get good in this space or better in this space more quickly. And we believe there are two opportunities. And again, this won't come as a surprise to this room. We have spoken to our investors around our Triple O's relationship and launched that, beyond the province of British Columbia last year. We've had some pandemic headwinds, but we're coming out of that now. But we've got a strong presence an emerging presence in the provinces of Alberta and now Ontario. So that's a great example of a partnership opportunity. But we also believe that an acquisition is certainly in the cards as well, and something that we would consider under the right circumstance. And again, we have two options here. It's do it ourselves, which is a long, heavy lift that requires significant expertise and training and time. And then there's the other option, which is let's go and find a business, find a brand, find a team that knows this, does it well, and can accelerate the opportunity for us. So those are the options that we're contemplating, and we're really excited about the road we've got ahead and the opportunities that exist in front of us. So just real quick on Journey, and Bob referenced it, around 2.5 million members. We're delighted with the uptake in Journey in Canada, to the point where we're expanding it as well into our US and international markets. I wanted to provide a couple of highlights. So we've been very focused on membership acquisition. You need to build a membership base in order to be able to have a meaningful marketing program and to make sure that the offers that you're investing in are actually having an impact. But let me just give you a couple of statistics. Average fill for a regular fuel customer, Journey customer versus non-Journey customer, up 12%. Average fill, and this is a stat I really like, for a premium customer, okay, so those are buying premium fuel from us, up 18%. Average fill from a diesel customer, and these tend to be small business diesel customers, 1, 2 truck shops, up 28%. So they're seeing the value. Our average C-store basket, up 10%. And then we're also gaining significant market share with CIBC customers. So we've got a recipe that is working. The key for us is to continue to evolve the program and the offer. You'll see a next generation app next year. You'll see connection to payments. Darren will talk about the connection to the EV customer. This is our engine for growth. We're going to invest in personalization. We're doing some beta testing now with terrific initial results around personalized offers versus generic offers, and the impact that it can have making the right offer to the right customer at the right time of day. So more on that as we progress our thinking and our evolution in that area. But now we want to continue to progress, and certainly in new markets like the US and the international market, our customer base. But we're going to push very hard now and continue to invest time, effort, resources into our proprietary personalization engine that allows us to make that personal connection to our customer. And then finally, it is a road, right? And it's a road that is changing and evolving for our customer base. So we believe that there are a number of points of interruption along a customer's literal journey that we need to be part of, we want to be part of, to help them be efficient. So, from trip planning right through to the final transaction and a return offer for our customer base, these are areas that we're spending, again, considerable time researching, understanding. Again, you saw the segmentation efforts that we've taken on to understand the role that we can play in our customers' journey to meet and exceed their expectations from both their energy needs, in our forecourts and through charging, but also through our convenience store offer through food and convenience. At the end of the day, the one thing I'll leave you with before I invite Darren up, and we hear it over and over again, is choice. Customers want choice. We're here to provide it to them and help them make the most of every stop. So with that, I'll pass it over to Darren to talk about our EV plan.
All right, good morning. My name's Darren Smart, and I'm the Senior Vice President of Strategy and Corporate Development. And we've talked about it a few times already this morning. Now is the time when we can dig into EVs in a little more detail. So while we see fuel demand as being resilient and even growing in some of our markets, we also know that EVs are here to stay. And this new growth segment provides an exciting new opportunity for us to build a charging business under the OTR brand. Now, one of the key questions in the EV space is really around pace and adoption. And what we do see in the data is that EV penetration varies widely by region. And so that is why we are focusing our initial efforts in the province of BC, where we see higher levels of penetration than our other markets. So earlier this year, we announced that we would be installing ultra-fast chargers in 25 of our strategically located sites along major highways in the province of BC. Now, this is our first step in creating an en route network and allows us to serve those customers who are on a longer journey and they need to charge before they reach their destination. Now, a really critical part of our EV strategy is to leverage and build upon our retail foundation. So we have existing sites, we have existing customers who know where the sites are, have even been there. We have an established loyalty program, and we have a superior backcourt offer. We've talked about OTR convenience and triple O's. And as we invest further in the backcourt offer, we make that offering even more attractive to the EV customer. So we're very excited about the EV opportunity. It leverages many of our strengths. And importantly, we do have the opportunity to take the learnings from our EV activities in BC and then port those over to other regions as penetration in those other locations makes sense for us to add an EV offer over time. So let's talk about EV economics. And to talk economics, we need to first think about customer behavior. And so the EV customer will seek to charge in ways that reduce and minimize the amount of friction in their daily lives. So we will see people charging at home. and we will see people charging at destinations, places they stop in their daily routines in life. The third place where people will charge is in an en route network when they're on a longer trip somewhere. And we believe that that en route charging channel will account for probably 10 to 20% of overall charging activity. Now, in terms of EV customer behavior, it's still early innings, but we can start to estimate what the impact will be. And so on this chart, we've shown the conventional customer that has an internal combustion engine vehicle, as well as the EV customer. And what you can see is that the EV customer will visit the site fewer times over the course of a year, but really critical is that when they do visit, their dwell times will be significantly longer. Perhaps 15, 30 minutes, maybe even longer than that. And that creates a significant backcourt opportunity for us to clearly provide food, beverage, convenience store items, and very importantly, to link people into the Journey Rewards program. And in light of the fact that the EV customer, when they do stop, that trip is more valuable, our backcourt investments do benefit us in two important ways. First of all, they definitely allow us to serve that EV customer. But secondly, they also allow us to provide an even better experience for our conventional customer who is still attracted to an attractive backcourt offer. One other note I would make is that in these economics, the one thing we haven't incorporated is the impact of carbon credits. So in the province of BC, beginning in the new year, cars that are charged in an en route network will generate carbon credits, and those credits will enhance these economics further. And Parkland in particular is well placed to monetize those credits. We're already a very important player in the BC carbon credit market through our activities in Burnaby and in the renewable fuels activities that Ryan will describe. And so we're well placed to make sure we maximize the value of that stream as well. So now thinking a little bit beyond the en route opportunity, we're also evaluating the opportunity to be involved in home and destination charging. And really the idea here is to follow the customer where they're going to charge and to create a seamless experience so that they see OTR charging wherever they and however they plan to charge. Now, as we think about entering those markets, we would look to use our customer base, our Journey program, and do so in a very capital efficient way. So when we kind of step back and look overall at the EV business, we do want to ensure that the OTR EV charging network is the charging network of choice. We believe that customers will seek out the most comprehensive network with the highest quality offers, and our retail platform and capabilities position us very well. There are network benefits and network effects of being in all of the charging channels. Now, clearly, our loyalty and our retail capabilities give us advantaged economics on the en route channel, but we can also remain top of mind for our customers by being in those other channels as well. And so as we look to link an en route network with potentially home and destination, we feel like we will provide a really compelling EV opportunity for this emerging customer base. Great, so to summarize our diversification strategy, we are creating convenience destinations. We're making investments across convenience, EV charging, food, and loyalty, and we're making our sites better for today and strengthening them for the future. In the convenience space and in OTR, we're expanding OTR to include standalone convenience stores and to include EV charging. In food, we are looking to expand our capabilities there through strategic partnerships as well as acquisitions. And in digital, we're creating sticky customer relationships and using our learnings to improve and hone our customer value proposition. And so by leveraging and building upon our strengths, we are uniquely positioned to meet the evolving needs of the retail customer in the future. And so with that, I'll pass things over to Ryan to talk about decarbonization.
Okay. Good morning, everybody. My name is Ryan Krogmeyer. I am the Senior Vice President of Supply, Trading, and Refining at Parkland. We are going on a couple hours sitting, so a suggestion, why don't we stand up, stretch our legs, take a deep breath, and then we'll take this home. Okay, we'll transition over into decarbonize. Those of you who are on the webcast, please feel free to do the same. Get a little oxygen moving through the system. Okay, when you're ready, have a seat, and we will jump into the decarbonize strategy. And we are running a little bit behind schedule, so I'm going to try and catch us up, okay? So our strategy around decarbonizing our commercial customer value propositions really focuses on leveraging our existing asset base and our capabilities. So a couple key points I'd like to make. We are not venturing into unknown territory. We are not getting over our skis. We are playing to our strengths, and we have significant opportunities in this space. This is not an existential threat for Parkland, that being the energy transition. This offers up tremendous opportunities that for Parkland will drive fantastic returns, provide a competitive advantage that leverages the existing competitive advantage we have, and deploys capital in a highly efficient and effective manner. I want to spend a few moments discussing what are our three core beliefs that guide our actions in this space. I'm going to take some time here, and then I'm going to accelerate through the rest of the presentation. These core beliefs are really important for us. Bob touched on them briefly earlier in his opening comments. I want to spend a little more time. First belief. Commercial decarbonization will take time and vary by sector, with customers having both conventional and low carbon assets in their fleets. So we talked about the fact that some sectors, for example, the aviation and marine businesses, are going to take a lot longer to decarbonize than the on-road light vehicle sector, right? They need that energy density rich fuel to make those long journeys across the oceans and across the open skies, okay? And technology will need some time to catch up around powertrain systems that deliver alternative fuels. Secondly, regulators will introduce and advance clean fuel standards which support renewable fuels manufacturing, blending infrastructure, and marketing capabilities. Thirdly, our own Parkland renewable fuels manufacturing capabilities are best in class. We are leading in North America when it comes to co-processing biofeedstocks in our fluidized catalytic cracker and our distillate hydrotreating unit. We are growing in this space, and we are ideally situated to meet the customer demands in British Columbia. Co-processing at the Burnaby refinery is a critical component of this strategy. We co-processed an average of 2,300 barrels per day of biofeedstocks at Burnaby in the third quarter. We intend to grow this volume that we co-process to 5,500 barrels per day by 2025. How are we going to do this? We're going to do it by leveraging, again, our existing capabilities and the assets that we have. capabilities are important. And the capabilities are what drives us to some of the fantastic results that you see up here that we report in our supply segment. I want to touch on a few of those. Our expertise in co-processing at the Burnaby refinery. We've been on this journey now for 5-6 years, and we continue to fight through all of the challenges and limitations and constraints that then allow us to move up on higher processing rates and further efficiency. Safe and reliable operations at Parkland underpin everything that we do. And I'm super proud of the team because their efforts have enabled us to get full utilization out of our assets across the entire value chain. In the third quarter of this year, the Burnaby refinery ran at 101% of nameplate capacity. So that's a 101% utilization of our asset. That's what it takes in this game to win. It is that kind of effort, and it's those kind of results that the team is getting. So fantastic job, team. I'd also like to mention that we've been able to reduce the amount of capital that we have to put into the Burnaby refinery every year to sustain operations by $30 million annually, starting next year. So again, we're looking for new technologies, many of those digital in nature, and other methods that enable us to really reduce the amount, again, of sustained capital that we have to put into our asset there. We have existing logistics capabilities, which my colleagues talked about earlier, across our entire value chain, internationally, in North America, that is unparalleled in the industry. We use several modes of transportation to drive our supply optionality and our product reliability. Those include trucks, rails, ships, and of course, pipelines. Last but not least, we have an existing environmental compliance and carbon offset marketing and trading business that we will continue to grow and leverage the expertise to address what is inarguably an incredibly large and growing market. Okay, we work with our customers. Our strategy is very customer-centric here. We are not pursuing any strategy as a science project. It has to deliver on three important things. It has to deliver a competitive advantage, it has to be highly capital efficient, and it has to deliver outsized returns. And I think you'll see that. There are 4 specific strategies that we are pursuing. First one is increase renewable fuels manufacturing at our Burnaby refinery. Secondly, grow our environmental compliance and carbon offset marketing and trading business. Continue to deliver renewable products to our customers safely, reliably, and on time. And last but not least, pursue commercial solar power opportunities in select markets. Low carbon fuel standards regulations are really driving a sea change in our industry. And as you can see here from the chart on the screen on the left, this is a representation of British Columbia's low carbon fuel standard regulations. You can see from 2010 to 2030, the regulations call for a 20% reduction in the carbon intensity of transportation fuels. That's under current regulations. Those requirements may actually go even lower under the newly proposed BC Clean standards, and you could see that carbon intensity reduction increase, that requirement to decrease by another 10% out to 2030. It takes a tremendous amount of biofuels to be able to hit those targets. And so the chart that you see, which is on your right here, shows you almost a tripling of demand for biodiesel and HDRD, or hydrogenated derived renewable diesel, over the course of the next 9-10 years to be able to meet those existing low carbon fuel standards in British Columbia. Right? So North America, the US, Canada, they will be global leaders in decarbonizing. And you can see, again, what is required to meet those lofty objectives. So co-processing more biofeedstocks at our Burnaby refinery is key to our strategy. It builds on some existing competitive advantages that we have in the marketplace. And I want to talk about those existing advantages for a moment. First one is, we are not a merchant refiner, okay? We don't hang our shingle out at the end of the dock. We don't post a price at our truck rack at the refinery. We actually move 85% or more of what we produce through our proprietary sales channels, retail, commercial, and wholesale. And what that does is it allows us to focus on making that value chain, those supply chains, and the delivery of those products to our customers as efficient and cost-effective as possible. So it's that integration in this orbit that really allows us to extract full value. And that's something that we can build upon when we think about the increased demand for low-carbon fuels. We have access to price-advantaged crude. We are at the end of the Trans Mountain pipeline system, and we buy quite a bit of crude oil out of Alberta primarily. We have locked in locally sourced biofeedstocks for our co-processing requirements through the end of next year. Our team does a fantastic job in staying connected with all the biofeedstock suppliers. And of course, we are constantly looking to ensure that we have a ratable supply. In the lower mainland of British Columbia, and specifically in the Vancouver metropolitan area, we have an advantage because of the stringent low-carbon fuel standards, coupled with some, I would say, limitations on product import infrastructure. You know, the infrastructure used to be 5 refineries at one time in Vancouver. There's 1 now. And unfortunately, with the growth in the market and the limits on the infrastructure build-outs over time, it's not that easy to supply. So again, these competitive advantages are what we're going to use as our foundation to participate in the energy transition. But we're going to do it responsibly, and we're going to do it efficiently. Okay, at Burnaby, on our co-processing journey, we have invested roughly $30 million of capital to date, and this has enabled us to produce or manufacture 100 million liters of low-carbon fuels at the refinery this year. Our ambition is to grow that number to over 300 million liters of low-carbon transportation fuels in 2025. We're going to do this responsibly, again, in a highly capital-efficient manner and with excellent returns. Why great returns? On the chart on your right, you can see that co-processing enables us to meet our compliance obligation in British Columbia at roughly 33% less cost than our alternative and our competitors' alternative of importing HDRD, blending, and getting it to market. Okay, second leg of our strategy. We're going to continue to build off of our existing capabilities and grow in what we call the environmental compliance and carbon offset trading and marketing space. So really 2 segments here. One is environmental compliance products. These are all the things that come from the regulatory regimes, okay? And we participate in many markets around the globe. Secondly, the carbon offset market. This is a growing market. Both of them are growing markets, and both have unique features. We have an existing team of very experienced traders, and we just added another team member last week, and we will continue to grow this business. So our unique capability here is when we enable the comprehensive bundling of physical product with the environmental compliance product or the carbon offsets to our customers, we can do it in a way that simplifies the complex. These markets, these carbon markets, have a lot of price risk, a lot of delivery risk. There is a lot of administration work you have to do to register and retire. And our team does a great job in managing and what I would call facilitating matching participants in the market. And it's a valuable service that we offer our existing customers. We'll continue to do the great product sourcing and delivery to our customers that we do across a broader spectrum of low carbon fuels and products. And last but not least, we will pursue commercial solar power development opportunities in places like Barbados that you saw on the video, but only in regimes where the regulatory framework is right, where the weather obviously looks good, sun shines, and last but not least, where we can drive a strong, healthy return. So that's the last leg of our stool. Okay, I want to recap here real quickly. As we move towards enabling the commercial decarbonization of our customers' business, we are going to do it, again, very responsibly and very thoughtfully. We will drive competitive advantage. The investments will be highly capital efficient, and they will drive strong returns. Take a look at the chart here. We'll invest $400 million through 2025 to generate $150 million of EBITDA through 2025, okay? This is good for the environment, it's good for society, it's good for our role in servicing our customers and the communities we work and live in. We're gonna take 350,000 cars off the road by 2025, every single year. And we're gonna take 1 million tons of carbon dioxide out of the atmosphere, right? And that's just the starting point. So again, we're very excited about this opportunity. We will do it responsibly, and we're looking forward to visiting with you all again in the future and showing you all the good work that's been done. So thank you, and with that, I'll turn it over to Christy. She's going to transition us into the sustainability space. Thank you.
Hi, good morning, everyone. I'm Christy Elliott. I'm Parkland's General Counsel and also our Chief Sustainability Officer. And I'm absolutely delighted to be here today to talk to you about Parkland's efforts around sustainability, or as we like to think of it, our drive to zero. You know, sustainability has always been a really foundational part of the way that Parkland does business. It has been, you know, for as long as we can remember. But it's really only in the last few years that we've started to take some steps to really formalize our efforts around sustainability. In 2019, the board established the ESG committee, and at the executive level, we stood up a sustainability task force. And that task force brings together senior leaders from across our business. And these are the senior leaders in the business who are really driving sustainability every day in everything that we do. And with our task force, those leaders come together, they share learnings, and they align our efforts on sustainability. And thanks to the work of the task force and really all of our Parklanders, we released our inaugural sustainability report in 2020. And today, we're extremely proud to have published our second sustainability report, our Drive to Zero. Drive to Zero is really how we think about sustainability at Parkland. It really sums up our ambition about sustainability. What do we mean when we say a drive to zero? It means that we're driving to net zero GHG emissions. We're driving to zero safety incidents and injuries in our business. And it also means that we have zero tolerance for discrimination and harassment and unethical conduct in the way that we conduct our business every day. There's some really exciting commitments and highlights in our Drive to Zero report that I hope all of you will read at some point. This one is one of the few documents I get to prepare as the lawyer of the company that doesn't put people to sleep. I think this one's really exciting. We included a GHG baseline and inventory and also targets around GHG emissions. This was a commitment we made in our inaugural report, and we're really excited to be able to share that data and information and targets with you today. We've also enhanced our application of leading globally recognized reporting standards, including this year the UN Sustainable Development Goals. And then finally, our report includes our enterprise-wide sustainability strategy and talks about how we're chasing this drive to zero, how we're advancing sustainability in Parkland through our people, our environment, our partners, all of which is underpinned by responsible growth. And as Bob mentioned earlier, we're absolutely delighted to have been recognized for our sustainability efforts. MSCI assigned us a AA rating this year. We're really proud of that, and we know that's just the beginning in terms of the recognition of our sustainability efforts and certainly our low carbon leadership. So as I mentioned just now, we have added the UN Sustainable Development Goals to our reporting this year. As all of you know, the Sustainable Development Goals are really urgent global issues that all of us collectively need to think about and address. And there's really 5 material SDGs that are most material to Parkland that we've addressed in our report and talked about the contributions we're making to it. The first SDG is SDG number 5, gender equality. This is one that's near and dear to my heart. And our contribution to this particular sustainable development goal is our commitment of 30% for gender diversity by 2023 and 30% gender diversity on our executive team by 2025. We've also committed to maintaining 10% representation at least of BIPOC and LGBTQ+ members on our board and executive team. The second SDG that we talk about in our report is affordable and clean energy. And in order to advance affordable and clean energy, we've committed to offering and encouraging low carbon fuels in all the markets we operate in by 2026. Third is the SDG of industry, innovation, and infrastructure. And as many of my colleagues have talked about earlier today, we have some really exciting things going on in this area. In particular, we're launching the largest, by site count, EV ultra-fast charging network in British Columbia. And we're also expanding our solar infrastructure in the Caribbean. And both of these initiatives are so important, not just to our sustainability efforts and our drive to zero, but also to creating the expertise and learning that can really contribute to our decarbonization and diversification efforts across our business. So of course, SDG number 13, climate action, is a key one related to our sustainability efforts. And we have set GHG intensity or emission intensity reduction targets. I'm going to talk about those in a little bit more detail in a moment. But we're also really looking at how can we reduce single-use items in our C-stores. Number 17 is partnerships. So how are we partnering with people to really achieve our sustainability ambitions? We have a number of really key, important partnerships, including our commitment to meaningful Indigenous relations. But more than that, to follow on from what Ryan was talking about just now in terms of co-processing, we have really exciting partnerships with governments, academic institutions, and also smaller private companies to really advance our work on second-generation feedstocks to fulfill the co-processing work we're doing at the refinery. We can take the innovation and the creativity that's happening in some of these other entities and combine it with our technical expertise and our infrastructure and do some absolutely incredible work with respect to second-generation feedstocks. So again, really talking about our drive to zero, our drive to be a more sustainable company, driving to net zero GHG emissions, zero safety incidents and injuries, and zero tolerance for discrimination, harassment, and of course, unethical conduct in our business. And in order to really propel us on our drive to zero, we've made a number of key highlights, or key commitments and targets, excuse me, to really push us on our drive to zero. And I'm going to talk about some of those commitments that we've made. Around climate change, we have committed to reduce our GHG emission intensity in our marketing business by 40% and in our refining business by 15% by 2030. And to add to that, we've also committed to help our customers reduce their own GHG emissions by 1 megaton a year by 2026 through our increased co-processing efforts. And both of those goals around GHG emission reductions are really in an effort to help support governments around the world and their broad ambition to reach net zero by 2050. As many of my colleagues have noted today, safety is 100% of the time Parkland's #1 priority, keeping our employees, our customers, and the communities that we operate in safe. It's our #1 priority. And our ambition around safety is, again, driving to zero, zero incidents, zero injuries. And in support of that ambition, we launched Parkland's Operational Excellence Management System, or POEMS, as we lovingly refer to it in Parkland. And that's been launched across our entire enterprise and all of our operating jurisdictions. And we feel strongly that that commitment to operational excellence and really putting structure around that is going to help us a lot on our drive to zero. We also, as Bob talked about and Ryan talked about earlier today, we move and store a lot of product in this business. You know, pipelines, ships, tanks, all different kinds of ways of moving and storing product. Our ambition is to keep that product where it's supposed to be and where it needs to be. Our ambition is zero spills. And in order to help push us on that ambition, we've committed to a 50% reduction in spill volume per liter sold. But again, our ambition is always continuing to drive to zero. In terms of diversity and inclusion, I talked earlier about the board and executive diversity targets that we've set for ourselves. But in addition to that, and Ferio and his team are conducting some really incredible awareness and training programs for all Parklanders, in addition to figuring out how each of us every day can really implement that systemic inclusion across our entire business. We've also committed to incorporating ESG metrics, or I should say additional ESG metrics, into executive compensation next year in 2022. And one of the things that I'm the most proud of is our commitment to conducting a sustainability assessment as part of all of our acquisitions and the due diligence process. We're one of the only companies in Canada that's made such a commitment to this. So details around all of these commitments can be found in our Drive to Zero and our sustainability report. We're really proud of it. We're excited about our Drive to Zero, and I encourage all of you to read it when you get a chance. So with that, I'm going to hand it over to our illustrious Chief Financial Officer, Marcel, to talk to us a little bit about finance.
Heck, I never showed up. Good morning, everyone. It's really great to see this many people here in person in the room, and also to have that many people online right in the back there. I hope you're still with us here. So my name is Marcel Teunissen. I'm the CFO at Parkland. I joined about a year ago, and it has been a really exciting ride to be part of the Parkland team here. My job is to bring you home here with the numbers, and really to talk about how the strategy that you heard today, how that translates into financials for the company, but very importantly also for financials for our shareholders, the owners of the company. So we at Parkland, we have a real track record of financial performance and driving the company. We have grown the company since 2016 by over $1 billion of adjusted EBITDA in that period. And when you take it from 2020, our reset year after COVID or in COVID, to 2025, our ambition is to grow that by another $1 billion of adjusted EBITDA. But we haven't just grown the business, we have also kind of translated that into, per share distributable cash flow for our shareholders in that period. So from 2016 to this year, where we are so far, the trailing 12 months, we have grown the distributable cash flow by over 4 times. And when we look out at our ambition year of 2025, we see another increase of about 50% on a per share basis. So when we talk about growth at Parkland, we very much look at through the eyes of the shareholder and how we can make sure that that growth accretes to shareholder value. We've also seen, and for those of you that followed us, that we have created a very resilient business. In 2020, just as a reminder, during COVID, in some of our markets, we lost up to 40% of our sales volumes when customers stayed home under various lockdown conditions. But when you look at the chart here on the left, in the dark gray there, you see that we managed to grow our marketing business, despite those lockdowns, by managing our costs, by managing our margins, by reducing our capital and reprioritizing that. We managed to continue to grow our business, our underlying business, our marketing business in that period. So all to say that we have created not only a growing business, but we have created a very resilient business. We believe that we kind of have seen the worst of the COVID pandemic, and that gives us confidence, that we can guide for 2020. We have a strong conviction in our strategy, in our own business, right? And that we'll see some of the green shoots that we've seen over the last few quarters. We see that further emerge as we go into 2020. And therefore, we decided to guide, and we've guided to $1.45 billion of EBITDA for next year, which is up 16% compared to our guidance for 2021 and up 50% from where we were in actual performance last year. We provided the usual ranges. There is still some degree of uncertainty, of course, there, but this means that we are well on track to get to our $2 billion a year of EBITDA, which is our ambition by 2025. With the M&A in the pipeline, and we're actively working on it, and you heard a couple of things here today that we have done recently, but I can promise you there's a bit more there to go. We believe that we will go well over $1.5 billion of EBITDA by next year. And of course, as we sign these deals, we will announce them, and you can add them up to our guidance for the year as well. I do want to point out, and it was mentioned briefly by Doug earlier as well, that we have been really busy in the last 12 months. We have announced 15 deals so far. Over $1.2 billion, $1.3 billion by now, so we've done a significant number of deals. And that was a bit busier than it would be normally, but that was partly driven by the external environment. The tax legislation in the US was driving a lot of vendors to come to us, and where we saw good opportunities, we have done that. We do expect that the deal level, the level of acquisitions, that will be normalizing here over the next little while as well as we go into the next year and the years after that. Capital expenditure, we also guided that as we've done before. That kind of reflects returning to normal. So you see our maintenance capital in the $225 to $275 million range. So that's kind of normal. There's a bit of kind of what we pass over from this year into next year with some COVID delays this year, so we push a little bit of that into the next year as well. So that's on the maintenance capital, and Ryan mentioned that somewhere in his presentation as well. We've really optimized that over the years. So our maintenance to kind of keep our assets going and to maintain the level of productivity, that we have really improved, that made it more efficient. And then on growth, this is organic growth capital, so $250 to $300 million for next year. We have choice there. Yeah, we believe that these are all kind of good investments. In Donna's presentation, you saw an example of that, where we invested in upgrading a site with an 18% return. We believe we have many of those opportunities, and we know we have many of these opportunities there, but we do have choice, and you will see us alternate sometimes between the inorganic expenditure that we do and the organic growth expenditure as well. So this is the guidance for organic growth, again with the usual range around those numbers. Let me now talk about shifting the portfolio. You've heard today about the strategy and how that translates into a shift in the portfolio. First, I will talk about the capital investment over this decade, and then I will talk about how that translates into the EBITDA outlook as well. So by 2025, we expect still to invest about half of our capital in the existing businesses and developing the existing businesses. So that's what Parkland has been doing in the past and done extremely well. We continue to invest in that business, which is core to the company and sets us up to grow the other businesses. You also see that by the middle of the decade, we have grown the investment in the diversification and the decarbonization themes that you heard about today. And that will grow to the end of the decade to about 2/3 of our capital allocation in that period. You can see a continued push into retail and convenience, including the C-stores, food, digital, electric vehicles, all the things that you've heard about today. And you see an ongoing investment in those resilient and growing markets, including the commercial segment, which we believe have a long and profitable runway. The last thing I will point out here is this growth in renewables. So Ryan has talked about the renewable fuel business, where we co-processing at the Burnaby refinery, but also the trading aspects, whether that's carbon or biofuel trading. There's an increase in that part of the business in terms of our capital allocation. And that capital allocation then shifts the EBITDA composition over the period. And again, these are stacks that add up to 100%, but we believe, of course, that our business will continue to grow. 2025, $2 billion and beyond as well. So in 2025, you'll see that there's a significant shift in that base business that we have to our growing, what we call the growing market. So markets where fuel demand continues to be strong, where the profitability opportunities continue to be there for us, that is a bigger component of our existing kind of platform and our fuels business. You see growing diversification as well. In on the run, food, EV, we talked about that starts really becoming material, especially when you start looking at 2030, where we believe that between diversification and the decarbonization themes, we have about 35% of our EBITDA will come out of those two themes. You see the increase of exposure to the relatively resilient fuel markets, the resilient fuel markets that is reduced, and a more focus on the growth markets. And so we talked about it early on in Bob's presentation, you saw that. So that's in the US, in our international business, we continue to see growth, whereas in the Canadian business, we're going to be much more focused as the overall company is growing. And the last thing I will point out is growing renewables as we grow our business, as well as the refinery, the conventional refinery that we have in Burnaby, that will have reduced in its relative contribution to the EBITDA of the company to around 15% or less. Let me now talk about how we think about capital allocation within the company and the discussions we have there. Fundamentally, that hasn't changed, and we've shared this before with you here. Our number one priority is to grow the business, and we believe that generates, ultimately the best, kind of returns for our shareholder. Second, we'll manage our leverage, and then third, we'll manage additional shareholder distributions. So when we talk about reinvesting, to grow the business, we do see, many accretive and attractive return opportunities in our business, whether they're within our kind of developed business, in our diversify theme or decarbonization theme. We see great opportunities to continue to invest in that. And what you therefore expect to see over time is really that increase in retail and renewables weight within our portfolio. You see a reduction in the weight of our conventional refinery in that portfolio, as I showed on the previous chart. And ultimately, you see a business that in scale and scope is bigger than it is today. Second, in terms of managing leverage, really nothing new there. We continue to manage the balance sheet below 3.5 turns debt over EBITDA, as we currently are, and we'll continue to do that. And we also continue to use equity where that makes sense, and where it's strategic and where it's accretive to shareholders. And you've heard some of those things said today about the deals that we have done recently. These are part of an overall deal when we talk to our vendors. These are vendors that want to be part of Parkland. It helps the overall purchase. It helps the alignment as the integration happens there. And so where we see opportunities to do that, we'll use it, but we'll use it sparingly, and we only do it when it's accretive and when it's strategic. We also continue to look out over the medium term to improving our balance sheet and to get to these investment grade metrics for overall debt levels, but also in terms of overall, diversification of the portfolio, as we continue to grow the company. And again, I already talked about vendor takebacks. They are an important instrument in terms of aligning our shareholders, or the sellers of businesses to our company, and to help getting those deals over the line as well. And then finally, we have a great track record of actually increasing dividend. We have consecutively increased dividends over a long period now here at Parkland, and we see that we continue to actually do that as well. We continue to maintain a low payout ratio that, again, that gives us the money to kind of grow our business, right? But also, if we see that opportunity and where that makes sense, we're also thinking about share buybacks as well to increase that return to our shareholders. So my last slide, let me just bring this all together in terms of what this means for Parkland in the overall kind of financial framework. We are a real cash engine, right? Most of the cash that you see on the left, the $4.5 billion that we generate over the next 4 years, comes from investments that we have already made. So that's the amount of, when we talk about the cash conversion and what we do, this is the cash conversion, and this is how the flywheel works within Parkland. That cash on the left pays for dividends, and we did assume here there's a modest growth in that, and almost 3/4 of the growth investments that we are planning to make. And those growth investments will generate cash, and returns, for the second half of the decade and the next one as well. In this plan, we do see the need for additional funding, and the way we think of additional funding and the mix of additional funding will very much depend on the balance sheet at the time. We very much look at accretion for our shareholders, and then ultimately, we do have choice. We don't have to execute this plan. When it doesn't make sense, we don't have to do it, but we believe it makes sense. We believe that is what drives most of the shareholder value growth here in this period. So we have conviction in our strategy. We have a track record of value creation, and you've heard that from us today. And again, where needed, we'll have choice and reallocate capital to where we see the best returns. And with that, Bob, I will hand it over to you.
Okay, well, thank you for attending. It was great to hear from the team to talk about the attractive growth opportunities that Parkland has. We have been a growth company, we are a growth company, and we will continue to grow. What you've heard from the team is the opportunity to develop our base business in attractive areas in demand-resilient markets where we have a long pipeline to continue to consolidate. We've also talked about the opportunities that present themselves through the energy transition, whether that's continuing to invest in our retail business, in convenience as a destination, or also pushing and helping our customers decarbonize. And again, that strategy will position Parkland to win in the long term, to continue to drive value for our shareholders and create a great company going forward. So with that, I'd like to open it up to any questions that may be there. Ferio, did you want to lead off? And so we do have a number that have come in over the internet of folks that have listened in. Oh, okay. We are going to send. Sure. Okay, great. Okay, do you have the questions? Oh, okay. Got it. Yeah. Oh, right.
All right. Well, welcome to the interactive portion of the day. Everybody's been sitting there quietly and patiently. This is your chance to ask the team any questions that you see fit. I think there's a lot put into a full day here, a full morning of presentations. We have our production crew in the back and members of our IR team that are going to be taking and moderating questions from those that are watching online. And then we'll have some runners here that'll work the room for questions here that come from the floor. So we'll try to make this as flexible, as interactive as possible. I'll go back and forth, a few questions from the line, a few questions from the floor, and we'll manage it from there. And I'll be reading them from the prompt up here. So appreciate again your engagement, and let's get started. So first question, panel. Guidance looks strong. Does it include Sol, the 25%? And what is our plan for Sol on the 25%? So probably Bob, Marcel might be best to lead in on this one.
Sure. Let me maybe start with the first question here. So the guidance does not include Sol. So what we put in the guidance are all the deals that we have signed, and announced. And so Sol is not part of that guidance for 2022. Well.
Yeah, in terms of, as Marcel said, it doesn't include in our guidance purchasing Sol. We do have an option to purchase Sol. We do have a great business, and we do have great business partners there. The Simpsons continue to own 25% of that business. We will purchase that at a time where it makes sense, where our balance sheet allows it, and where it's accretive to us. So again, the great beauty there is we do have an option to purchase it. We don't have to trigger that option, and we can do it when the timing fits us.
There was a few references in the presentation here with respect to the credit, the rating agencies and so on. Marcel, timing of the next rating and potential increase, what's your thoughts?
Yeah, no, that's a great question, of course, an easy one for me to answer because we don't decide when the rating agencies decide to review us. We have been in the market this year 4 times for high-yield bonds, as you all know, and every time we have had great support from the rating agencies, the 4 rating agencies that actually rate us. When we talk about the metrics and we look at our financials going forward, we do believe, as I said, that we have a good cash engine and that over time we will be able to bring leverage down a bit, which is one of those things we'll talk to the agencies about. And the other bit is as we kind of broaden the scope of our business, that's an important part as well, and we continue to work that, but in the order of priority that I shared during the presentation as well.
Thanks, Marcel. We're going to take a few from the floor. Let's start here in the center, and we can work our way left.
Hi, thank you. It's Ben Isaacson from Scotiabank. Just 2 questions for you. You talk about adding some standalone stores over the coming years. Can you talk about what the format will look like? Are you going to have those standalone convenience stores having fresh produce, like grocery items? Is it going to be some kind of pharmacy as well, or is it just going to be really what the existing C-store looks like, but without the fuel?
Maybe that's one that, Ian, maybe you can start on that one.
Yeah, Ben, thanks for the question. I would say, the answer is it'll depend. So it'll be subject to the market, it'll be subject to the customer need, the density. And when you talk about fresh as an example, and one of the things I referenced in my commentary is that fresh can be delivered in a number of ways, and we want to make sure that that is operationally efficient. So will it look like the existing convenience store today? No, it needs to be different. It needs to be more interactive. It needs to be suited to that particular market. Will it have some of the traits of the existing stores? Absolutely, where we've had success in our core products and services, but I would look to see an evolution of experience, not just in standalone, but across really the entire network. But we think standalone is a great opportunity for us to lean into some of these emerging technologies and points of interaction, particularly with Journey, and to evolve the assortment to meet those local needs. So a combination, I would say.
Great, thanks. And my second question on the energy transition. I guess it's a 2-part question. You started setting up some of these locations in September. Can you talk about some of the early data that you've seen in terms of when you showed the slide on EV economics, was that based on what's happening at Parkland, or that's your guesstimate in terms of what to expect? Are people actually spending 30 minutes so far? Are they spending more per se?
Yeah.
Sure.
Derek. I can go Ian and Derek.
Why don't I take that one? Yeah, so those EV economics in the chart are based on a lot of extensive industry research, and we look to other jurisdictions that are further ahead. And so that is kind of what we're seeing in other jurisdictions. What we do have is we have a site that we've opened up in Kelowna, and that site is kind of currently tracking actually slightly above in terms of utilization where we thought it might at this point. So some good returns so far.
And just final part on the energy transition from me is, can you talk about the carbon credits and who do the carbon credits actually belong to? And I guess I don't mean in the refinery, but when customers are charging at your fuel stations, are they generating carbon credits that belong to them? Do they belong to you? Is it something that you will purchase and trade?
Yeah, so those carbon credits will accrue to the owner of the charging infrastructure. So they accrue to us in that en route network, and then we will monetize those credits as part of our activities and kind of what we currently do in other parts of our business where we generate credits.
Thanks for the questions, Ben. We'll go to one more on the floor, and we'll go back online and come back again. So over here.
Yeah, thanks everyone. Derek Delay, Canaccord Genuity. Just a couple questions on acquisitions. Recently, we've seen the acquisitions focused on the U.S. and international, and I think you mentioned in the U.S. we've seen EBITDA go to 120, 130 right now. Is there a target for 2025 on where that can go? Doug, I think you mentioned you can create a whole nother Parkland just within the states you're in. I'm not going to put that in my numbers, but wondering if there's a target there.
Doug, over to you.
Yeah, that's a great question. I mean, we have launched internally, and our vision is, we call it 5 by 25, and that's to 5x the business from where we are now in the U.S. by the year 2025. So you could apply that to earnings, sites, employees, trucks, that we think the whole business moves forward at about that pace.
Okay, that's helpful. And then in Canada, it sounds like the acquisitions are going to be focused more so on the commercial side. You mentioned propane and diesel, but an interesting comment I thought was just the comment on the potential for accelerating your fresh food or your food offering with the acquisition of a brand. What would the criteria be for an acquisition of that nature?
Yeah, so similar to what I referenced on in my slides, it's got to be a couple of things, and they're key. One is a great brand. So a brand that is known, that is already well penetrated. 2 is capability, and 3 is innovative. So we want, and I guess 4 would be customer focused, and I'm not sure I've got the order right, but gives you a sense for, we need to be able to, in an acquisition or partnership scenario, be able to very quickly pull that team in and those capabilities in and the brands and accelerate that across our entire network and also the future network that we articulated today, particularly around standalone, for us to be excited about an opportunity like that.
Thank you. We're going to go to one more from the line here. So interesting question, Ryan, maybe this one for you. Marcel, you can opine as well, but obviously through the presentations, a good implied level of return on opportunities for capital to be put into decarbonization. So view on that and any limitations in the refinery leading to preventing us from getting there.
Great question, obviously. In the decarbonization space, like everywhere, you have a stack of opportunities that have an associated return on invested capital that goes along with them. And our stack is not uniform across all those opportunities that I mentioned earlier when I spoke. We are focused, again, on growing our co-processing capabilities at the Burnaby refinery because in that stack, that is probably the highest return opportunity that we have. The other opportunities show very good returns that hurdle. And we will, of course, continue to look at new opportunities in this space, again, as long as they meet those 3 criteria I mentioned. You know, does it provide a strong financial return? Is it capital efficient? And does it leverage our competitive advantage and help us grow it? So absolutely, we will keep looking.
Just building on that, you know, coming in here with respect to utilization, what is the expected utilization in 2022 you're anticipating the refinery?
2022 utilization at the refinery in Burnaby is expected to be very high. And the reason is we do not have a turnaround next year for maintenance work of any significance. So this is what is going to propel us to historically very high utilization rates for 2022 at the refinery.
Thanks, Ryan. We're going to shift back to the room. Other questions from the floor? Center over here.
Thanks for taking my question. Great presentation. Maybe a two-part question for me. Just on your EV growth strategy, you know, how do you balance being methodical? You know, you showed some pretty good economics there. Like, how do you balance being methodical versus maybe having a first mover advantage given the amount of subsidies the government seems to be throwing at trying to build out this, you know, in-transit EV network to drive more EV adoption? And then secondly, maybe Donna, you talked about grading these sites and trying to move to 80%. Just wondering how EV, you know, an EV charging network changes how you evaluate a site in terms of what was you know, does it change what was an A site before to being an A site in the future, for example?
Do we want to start with Darren and then over to Donna?
Sure. Yeah, so in terms of balancing the EV growth, so you know, you're right, there is a need for us to balance a few different things. I think it kind of starts with the fact that we're in the highest EV penetration market in BC. And so we are, you know, in a very selective way, we've chosen kind of these key 25 sites where we will test, and we will get the chance to look at behavior and also you know, access some of the government subsidies that are out there. And so that's, you know, that is kind of the first wave for us to see how things go. And so, you know, we are able to, in a fairly capital light way, begin to test, and then we'll, you know, learn from that experience and decide how to invest thereafter. Maybe
Donna?
Yep, and then from a network perspective, you know, we have sites that are, I would say, more in neighborhoods, and we believe that, you know, people will be charging at home more likely when they can, but that for those either highway sites or, you know, when you're making a road trip or you've got a longer ways to travel, that certainly those would be more likely locations where the chargers would do better. And so, as I mentioned, we have this network development process, and we're actually going through the network right now, pending how the outcome is of what we learn from the test or the launch that we're doing in BC. And from that, we'll then, you know, modify our criteria and put it into the forward plan for how we do network development.
Thanks, Donna. Thanks, Darren. We'll take another one from the floor over here.
Hi, can you hear me okay?
We sure can.
All right, thanks. This is Matthew from IA Capital Markets. Great presentation. I'm wondering, with the 5-year ambition for $2 billion EBITDA presented a little bit differently, it looks like more of kind of a pivot to more energy transition, non-fuels, that sort of thing. Is the outlook a little bit different for the proportion of that that's coming from organic growth as opposed to acquisition? I think it previously been laid out as the majority being driven by acquisition and synergies. I'm just wondering if that expectation's changed going forward.
Very good question. I think it could cover the board here with that one. Why don't we start with Bob?
Yeah. Certainly we will continue to grow the business organically, and these two areas will be a big push. In terms of the exact proportion, I think Marcel outlined quite well how those earnings will start to look going forward, so you can see roughly how that split will shape out. We will continue to buy businesses. We will continue to get synergies. We can't control the timing of those businesses and when we get them, but I would say when you look 5 years out, you can see the proportion of those businesses and investments, and that's a mixture of organic and M&A that we've typically done.
Okay,
We'll
thank you. Just one more question, if that's okay from me.
Sure.
So looking at the guidance and kind of what's built in and the internal assumptions, would you say there's upside based on, the supply-demand projections for renewable fuels, the evolving low-carbon fuel standards in BC, based on, A, would you expect to be a net generator of those credits going forward through the planned horizon, and then B, do you see upside to your projections based on where those credits are going to trade down the road?
Why don't we, Ryan, maybe Christy, you might comment as well.
Yeah, I'd be happy to. So first part of your question, and please correct me if I get it wrong. The answer is yes, we are a net generator of credits, what we call LCFS credits in British Columbia. And I think your second question relates to, do we have a view on future value of those credits relative to where they're trading or market value today? And the short answer is it's pretty tough to predict future prices, particularly for instruments like the low carbon fuel standard credits in British Columbia. So watch this space and we'll see what unfolds.
Christy?
Okay, thank you. That's helpful.
Good. Okay, we're going to go back online. We'll come back to the floor. Question, Pierre. So market share in our top Caribbean countries, and what other room or opportunity you see there for consolidation?
Yeah, thanks. If you think of our two largest markets, Puerto Rico and the Dominican Republic, from a retail perspective, in Puerto Rico, we're north of 30%. In the Dominican Republic, we're north of 25%. So there's, I think we have to be very, very selective in terms of future growth within those big retail markets. However, if you zoom out at the regional basis, the Caribbean has a population of 43 million, and we have market share which is significant, but there's lots of room to grow in markets where we can generate quick cycle, highly synergistic transactions by putting new markets such as Jamaica. We'd love to have a presence in Jamaica, which is a high growth, stable market, onto our supply platform to generate very significant shareholder return. So lots of opportunity.
Thanks, Pierre. Question for Doug. And in case anybody hasn't noticed, Doug is donning his On-the-Run socks today, which he's mandated for all members of the U.S. Parkland team to help advance the brand. Looking good. Why are the family businesses selling in the U.S.?
It's a great question. I think it's important to understand the history of the industry in the U.S. with these independent companies. Most of them were founded after World War II. And so we're in the middle of a generational handoff. There's about 3,000 of these companies left. They're handing from the second to third generation, which, as we all know, in pretty much any industry is a single-digit success rate. Ours is no different. And so in most cases, these families are in need of a solution. They may be making that handoff to the third generation, but asking them to come work for us. In both the Lynch case and the Urbaneda case, the next generation of leadership is coming to Parkland. So they're going to work with us on the U.S. leadership team. It's great talent for us to add to our team, and it's a great transition for the family, and in terms of their planning was viewed as the right exit for them. So a lot of it is, one, having a reputation of being good at dealing with that and getting families through that transition effectively, which we've built quite strongly. And two, just taking advantage of that generational transition that the whole industry is, in the middle of for the next 10 years. That's the transition that's going on in that part of the industry.
Very good, Doug. Thank you. Let's go back to the floor. A few questions. We got one here and then one up here in the front.
Good morning. Great presentation, and thanks for hosting the day. David Newman from Desjardins. First question is, your footprint does skew toward suburban, rural, and with the EV charges it's skewing a bit more toward urban. So how do you balance it off, and are you kind of playing to the fact that maybe families might get one EV vehicle and one internal combustion vehicle?
Darren, do you want to touch on that, and then maybe Ian on the from market perspective?
Sure, so I can start. I mean, I think one of the key backbones to building out an EV network is the highway sites. And so, we think there are 80 to 100, maybe a few more highway sites across the country as time rolls on that are kind of key sites that one would want to have in the network. But importantly, we do think there is a transition, and that you will certainly see customers who have one of each, an EV and an ICE vehicle. And that's, part of the key of our strategy is that, through Journey, we provide a loyalty offer that covers both. We have en route sites that cover both customers and both types of vehicles very well. And those sites will be on the highway, but also in suburban locations as well. So it all fits very nicely as we think about the transition rolling out and there being a long period where there will be lots of ICE vehicles on the road. Donna.
Ian, Donna?
The second question, just on the refinery, it does generate a significant amount of cash flow and does help fund a number of your initiatives. But I think investors have come back often and talked about how it maybe hinders you a little bit in terms of your transition and the new energy transition overall. Would you consider divesting or spinning it off or striking a contract and guaranteeing that supply? Because I notice it is integrated with the Lower Mainland, and then you can use the proceeds and accelerate your efforts in ESG and building out the downstream and surfacing value. Or do you just feel that it's too integrated with what you're doing and it generates too much cash flow at this juncture?
Ryan?
Let Bob take that.
Bob?
Great question. Look, the refinery, and Ryan had a really good slide up there on the value that it creates and its unique position in the market. So, unlike most refineries that are merchant refineries, this is a highly integrated asset. And, we certainly see that it fits within our portfolio, and it also is an opportunity for us to drive our participation in decarbonization. So at this point, our intent is to keep the asset.
Okay, last one for me, Bob, is just on the, obviously you've got a lot of things that you're doing in the downstream, maybe just talking about, your home and destination chargers, maybe more color on the type of QSRs that you guys might be looking at, and then solar.
Yeah, do you want to talk about the type of QSRs?
Sure, yeah. I think David, what we talked about, and maybe just to reinforce, is we kind of see 4 key food groups. So, beef for burgers, chicken, pizza, tacos, as being sort of core areas that we want to be focused on in terms of developing competency and capability in that area. So I would say from a and also, back to day parting as well, ensuring that we've got the day parts covered and we're able to do it in the most efficient and effective way. So I had on my slide sort of those 3 different components of a fresh from frozen, and an HMR type opportunity. So those are areas around the categories of food, but also the occasion of food as well that we want to be able to deliver against.
I think there was a question too about solar. Is that correct?
Solar and then the chargers.
Home charging.
Yeah, so why don't you talk a bit about some of the opportunities we're seeing in the Caribbean?
Yeah, on the solar perspective, the right way to think about this is we're working from the customer back, so it's customer-led growth, where our commercial customers, and we're doing this with our own network as well, we're solarizing our sites. The electricity costs in the Caribbean are astronomical. They're very, very high. And so the value proposition to customers is strong. And unlike Canada and the US, it is not a crowded space. So we have a unique opportunity to support our customers as they integrate renewables into their energy mix And that allows us to test different concepts and be a provider of energy solutions which include electrons as well as hydrocarbons. And where we're getting traction right now with commercial and power customers is to help them with rooftop solar. And they're very strong IRRs for them, and the savings for the customers are very material.
Great, and to answer your question on EV charging, so again, our thinking and our strategy here would be to provide a seamless EV network that follows the customer where they charge. And so somebody would, if they charge at home or they charge at a destination, they're charging at an OTR charging point, and it keeps them in the network. And they're earning journey, and they're recognizing the brand. And being part of that seamless system, we think, creates a lot of value. Now, the chargers will be different. In the home, those are much slower, perhaps level 2 chargers. Destination, again, those aren't going to be the ultra high-speed chargers in our en-route network. They may very well be level 2 as well, again, depending on the dwell time that it makes the most sense for that destination.
Thanks, guys. Thanks for the question. David, we have one here in the front, and then we'll start back there, and then here, and then we'll go back online. So, rear of the room.
Thank you, everyone, for this, for hosting this presentation, and congrats on a successful Q3. So, just continuing on with the EV. So you have the 25 locations that have the ultra-fast EV chargers. So I just wanted to get some more color on that, like the amount of time that's reduced with these ultra-fast chargers, and also like what the potential value add is with that, because with these ultra-fast chargers, you'll be expecting that customers will spend less time at these locations. So I'm just wondering if like the margins will be higher for these chargers, or if there are any other opportunities to increase value.
Sure. So across the 25 sites, we will be installing those chargers in 2022. And I guess the way to think about that technology is, a level 3 charger is kind of defined as being 50 kilowatts of power and above. And so the chargers that we're installing, they will be providing about 150 kilowatts. And so that allows somebody to achieve, call it an 80% charge in approximately 20 minutes or so. And so, that I think is, first of all, we do want to get people on their way. And I think it's a very compelling proposition for us to have fast charging and for people to be able to move on to their destination. But within that period of time, that is lots of dwell time for people to take advantage of the backcourt food and convenience offers.
Okay, thanks for the response on that one, Darren. I'm getting the hook here on our 5-minute limit. Now there'll be a lot of opportunity to meet with the management team after this as well, and get a lot of your questions answered and share some comments on that. But we'll go to a few more questions online. But before that, we have a question here in the front. We'll take this one from the floor, and then we'll go to online.
Hi, thanks very much. So years ago, you used to talk about synergies in the range of 20% plus, and now you're talking 30 to 50%. So can you talk a little bit about, what has enabled you to get to that, up to that 30 to 50% level, and what are the characteristics of an acquisition that helps you get to the top end of that range?
Bob, do you want to start?
Yeah, why don't I kick off with that? So very typical to what we've described in the past. I think what you're seeing is the benefits of scale and better systems, better execution, better brands. And what we've typically said is there's 4 levers we pull. So the first is supply. We put that business onto our supply system. Our supply system's gotten much bigger. We've gotten more sophisticated. We've built better systems. We can get better value. The second is operational improvements that we'll make. And again, that can be rebranding a site. It can be improving its site-level execution. And again, with proprietary brands, with better execution, better data at a site level, we can get more out of that. And then third thing is back office. And as we put that business onto our back office platform, we get transactional efficiency. And again, we've invested in that platform. A little bit more to do in that area, but you know, for example, in the U.S. business, we do have a single platform that these businesses go on, and we start to see that. And then the final thing is growth, right? And again, this relates back to brands, loyalty, you know, in our commercial business, to looking at accessing larger accounts, national accounts. These are all things that we can enable these businesses to do that they weren't doing in the past to drive it. So therefore, we're getting, you know, more bullish on the ability to generate synergies, and certainly seeing ourselves start to push towards the high end. I don't know, Doug, did you want to comment specifically? I know you had an example up there that might provide some more insights into that.
You know, I think in the U.S., obviously, it's been a bit of a development job to kind of get to this point where we get the synergies faster, and we've got the scale and the systems. As Bob mentioned, all 17 of the current acquisitions that we've done in the last few years are all on a single ERP system. So we've been able to do that, what we call day one integration for most of those acquisitions, where up to the close, we translate the data, load the systems, do the testing, and literally we close on a Friday, and Monday we're billing out of our system. So it's a really robust process that the team's done a fantastic job at. So it is back office. It's certainly, you know, as Bob mentioned, these local businesses, in many of the U.S. markets, 20 to 25% of the demand is tied up in corporate national type of accounts. Those local businesses have never been able to access those accounts. We have a corporate accounts team that's quite sophisticated in terms of booking that business. We're exiting this year at close to a 400 million gallon run rate on that business that 2 years ago was zero. And so when you take an asset that perhaps is at 75% utilization, it's already making the EBITDA that we buy it at, and you can, you know, drop that additional throughput through that existing infrastructure, it's what I call a gross equals net. So, you know, whatever you're making on that additional business in gross profit is almost all net profit. So the yield on it is unbelievable. So those are the areas that in addition to supply, obviously have really helped us improve the performance on these companies.
Last question for the main forum here. We'll stay with you, Doug. Just, you know, there's been a press to move the OTR brand expansion through Canada. We're now venturing into the United States with that. How's that going? You know, through some of the photos we see multiple brands playing out there, but how's it going in the U.S.?
Well, I would note that the opening slide, if you saw that, and the one that opened the video, that is our new site in Bismarck, North Dakota. So that was our first on the run that we built. We did have plans to get 28 of those deployed this year. We won't meet that objective, largely due to supply chain implications. We haven't been able to get steel, fascia, you know, tile, I mean, everything you can imagine. So I think we'll end up probably getting 15 or 16 done this year. We intend to substantially accelerate that next year. We mentioned the transition with Urbaneda and those sites really being a step change opportunity for us. They're in one market. We get a lot of efficiency in terms of, you know, construction crews, work, you know, just planning the projects, being able to do it all in one city. So that really for us is where we choose, you know, that's the next level of acceleration for On the Run. And yeah, there's no, you know, lots of legacy brands as we buy these companies when they come in. But let's be clear, On the Run is our convenience brand for the U.S., and for stores that we own and operate as company operations, they will be On the Run.
Thanks, Doug. Okay, we're going to wrap there. We will be, as I said, available for further questions, and we'll be continuing to take questions. For those of you that are listening and following online, we will continue to take your questions and entertain those and feed you back responses as such. Please know we do have lunch for you today. Don't forget your gift bags on the way out as well. And once again, we would really, really like to thank you on behalf of this entire team and the 5,500 Parklanders, many of which are listening today and will be watching this later, who are out there that make this company a success day in and day out. They thank you as well. So thanks for following us. Thanks for believing in the story and being with us today. And we look forward to interacting with you here through the course of the afternoon. We will avail ourselves as necessary. Have a great day and stay safe. Cheers.